Our planet is facing environmental crises of unprecedented magnitude. Wildfires, flooding, earthquakes, natural disasters reshaping the lives of communities. Insurance has a vital role to play in addressing these challenges, and we must take action now. How will insurance help us tackle the climate crisis? Join visionaries driving innovation and securing our economic future at the Insurance in a Changing World conference. Insurance as a force for good and growth. Be a part of the conversation. Be a part of the solution.
Hello, everyone. Welcome. We have a few seats down at the front as well. If anyone's struggling to find a spot to sit down. Welcome. Wonderful to have you all here at the Conduit's Insurance in a Changing World conference. My name is Matt Farquharson. I am Editor-in-Chief here at the Conduit, and I'll be with you at various points over the course of the day today. We're here today to learn how this crucial industry can help us to protect lives and livelihoods and planet and build global economic opportunities. We're also here to meet and mingle and network. And if any of you would like to book a meeting space, there is a QR code here which you can zap to book a spot upstairs on the third floor if you'd like to have a little space to have more detailed conversations with anyone. Or you can just speak to a member of our partnerships team up in the Ubuntu Lounge, and they will find a spot for you. But for now, I'm delighted to hand over to our co-founder and CEO, Paul van Zyl.
So welcome to Insurance in a Changing World. My name is Paul van Zyl. I am a co-founder of the Conduit and its CEO. So a few preliminary things about Conduit conferences. As you will hear from a major announcement that we are making today, we hold events that are not talk shops. Our conferences are catalysts for action and designed to encourage creativity, networking, relationship building, and problem solving. One of the key goals of the Conduit is to make meaningful connections. So don't sit in the same place, smile and introduce yourself during the breaks. And in fact, we're going to try and do that right now to do some behavioral nudges and lay down some neural pathways. So turn to somebody you don't know, who you didn't come with, and say who you are. Okay, all right. Hello, 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 good, hello, hello, hello. Shh, shh. Okay, well, that is very discouraging. You clearly are a shy and retiring bunch. Great, that's a good start. Now keep doing that and don't sit in the same place and meet as many people as you can. So sometimes dealing with the climate crisis can feel like Sisyphus pushing that rock up a hill. But today, with this conference, we want to persuade you that insurance has a power to put wind in our climate sails. Insurers have a deep encyclopedic understanding of bad things that happen in the past. And this allows them to reduce the harm we experience when bad things happen in the future at an acceptable price, taking into account the magnitude and probability of this predicted harm. The climate crisis has placed this model under severe stress because the probability of future harm has shifted from unlikely to certain, and the damage has increased from affordable to catastrophic. And as a result, certain markets have become uninsurable or only insurable at an unaffordable price. But fortunately, there are several solution buckets which broadly align with industry interests. And two of those are prevention and adaptation. The insurance industry has an existential interest in preventing climate-related damage from occurring in the first place and minimizing that damage when it does occur. And it has several superpowers, including huge pools of assets, vast troves of data, and remarkable predictive powers. And its products can therefore be profoundly catalytic in tackling the climate crisis. They can enable green growth, they can underwrite new and established markets, and paradoxically, insurance can encourage risk-taking. Today you'll hear from 25 incredible speakers about how insurance can be harnessed as a force for good and growth. But this is just the beginning. This conference is the first of a regular set of convenings, and I'll leave our friends at Howden to tell you more about that. So my final task for now is to say thank you. So firstly, to our founding partner, Howden, to the indefatigable and charming Rowan Douglas, and to Anthony Hobley, to our supporting partners, Zurich, Amy Bertel, to our strategic partners, the World Business Council for Sustainable Development, Better Insurance Network, the Net Zero Lawyers Alliance, the Green Alliance, and the National Emergencies Trust, and to our media partners, Illuminum, Carbon Pulse, and the global risk community. A huge thank you to our speakers and contributors. They really are a stellar group of people, as you're about to hear. And thank you, as always, to our Conduit team. To Perez Kagbala, who heads Conduit Live, to Jay Kinsella, to Chris Simmons, Asher Delanarol, and Katya Lukina, to Meljo, Cheriam, and our ops team, to Sierra Palla and Mira Jabran Sari and the Impact Partner team, to Matt Farquharson and his team, and to Gillian Mundy, who smiles at reception and deals with all of our trivia, and to Duna and to Hess on event management. As you can see, it takes a village to pull this off, so let's get started. Thank you.
Good morning, everyone. I'm Barnaby Rugg-Price. I'm the chair of Howden UK and Ireland, a global insurance and reinsurance-based business here in the UK. And I've got the remnants of a cold, so there's a bit of coughing and spluttering. Please accept my apologies for that. But it's fantastic to be speaking to you here today at the Conduit Club and to be addressing some of the movers and shakers in public policy, academia and industry. And it's also fantastic to be shining a light on insurance, which is apparently a bit of a dry topic, if not downright boring. And yet it couldn't be less boring, and it couldn't be more important. Without insurance, the expansion of shipping trade in the 17th century would have been dead in the water. Without insurance for steam boilers, the Industrial Revolution of the 18th century would have evaporated. Without insurance, the dawn of the age of electricity in the 19th century would have shorted out. And without insurance, some of the institutions on which our modern world depends might never have got off the ground. Take the blueprint for our welfare state. It was in 1942 that the Beveridge Report undertook to slay 5 giants of idleness, ignorance, disease, squalor, and want. A task it framed through the prism of social insurance. And if we need proof of the value of insurance today, we don't need to look far. Insurance remains one of the city's finest performers, with a UK premium equivalent to just over 10% of GDP and London's still the dominant market for specialty insurance classes of marine, aviation and energy. On a personal level, I know how vital insurance can be for businesses and for people's livelihoods. I've worked in the industry for over 30 years, always based in London, yet by virtue of this city's preeminent position in the global insurance marketplace, I spend the vast majority of my time working with clients outside of the UK, helping them manage some of the most complex risks and exposures across the globe. My own specialist insurance subject for the past 30 years has been property, spending the majority of my time dealing with what we in the business call Nat Cat, or natural catastrophes: earthquakes, severe weather, windstorm, flood, and tornadoes. And for those unfortunate enough to be caught up in such disasters, insurance is their safety net, their lifeline. But in recent times, something has become increasingly and uncomfortably obvious to me. We used to think of Nat Cat as a once-in-a-lifetime event. We would talk of 50 or 100 or 250-year events, and our negotiations discussions focused almost exclusively on earthquake and windstorm. Sure, floods occurred, so did tornadoes, but they were unpredictable and infrequent. And as for wildfires, well, they were things that looked frightening on the news, but were generally confined to the countryside and didn't impact major urban areas. Well, not anymore. In fact, the insurance cost of natural catastrophes has exceeded $100 billion every year this decade. And in half of those years, that figure has been achieved by events that were once considered second tier: wildfire, flood, tornado, and without a single loss from an earthquake or a named windstorm, the two perils that we used to consider to be the real Nat Cat. 15 years ago, this would have been unthinkable. But as we scroll the news over the last 12 months, we've seen supersized hail in Germany, floods in the UAE and Oman, wildfires in Australia and California, and this is now normal. Those recent fires in the Palisades are also part of a broader problem. Weather events are becoming more severe, more frequent, and more complex. The authorities are pretty good at predicting and putting out a blaze. In fact, that's why there were so few fatalities in California. But they still find them hard to stop. The Palisade fires were complicated by winds in excess of 80 miles an hour, which stopped helicopters and planes getting into the air to douse the flames of a fire that was moving at the speed of 4 football fields a minute. And we've seen the consequences. Homes, livelihoods, businesses, schools, whole neighbourhoods went up in smoke, causing an expected industry loss of 40 billion. In fact, I saw a figure today saying it's creeping up to 50 billion. And as a typical rule of thumb, the total economic loss will be at least 5 times that number. Of course, extreme weather is only one facet of an increasingly tangled risk landscape. We're having to cope with Nat Cat, but also what we might now call Man Cat. International conflict, strikes, riots, civil commotion, as well as energy and food insecurity, are all exacerbated by population density and failing infrastructure. So what does all this mean for insurance? One immediate consequence has been the widening of the insurance protection gap, the difference between insured and uninsured losses, frequency of payouts, and the difficulty of raising premiums, often because of well-intended but counterproductive regulation, coupled with the assumption that the government in the end will step in to cover the risk, have eroded insurers' profits and led them to pull coverage in high-risk areas. And we continue to build homes in places where we shouldn't. On UK floodplains, in California hills, next to the sea in Miami. When the levees failed in Katrina's wake in New Orleans 20 years ago, the famous French Quarter escaped flooding. Why? Well, because back before levees existed, they knew they needed to build above sea level. The effects of this widening protection gap are being felt the world over. In Europe, it's harder to get flood insurance. In California, up to 80% of the homes affected by fire were underinsured or not insured at all. Keep this up, and in the coming years, we will be plunged into an insurability crisis. Because we're living in a new age of instability, the norms that we once took for granted have been turned on their head, the rules-based order is being challenged, old alliances are being shaken to their core, and extreme weather events are increasingly common. which means in the next quarter of a century, we're going to need more insurance, not less. After all, without insurance, you simply can't manage these risks, and what is uninsurable becomes uninvestable. So we're at a crossroads. Either we fail to insure communities, passing on unaffordable burden to consumers, or the government takes up the slack, putting impossible pressure on already constrained budgets. And the only way to sever this Gordian knot is for insurance to step into the spotlight. Instead of being seen as a monthly direct debit sold to you by meerkats, it must be regarded as a transformational tool, able to use its mastery of catastrophe modelling and risk management to tackle tomorrow's intractable problems, and critical to unlocking finance for industrial decarbonisation technology. We often read about what insurance fails to deliver, but far less about what it delivers every day. To return to the recent California wildfires, the insurance industry is currently paying out billions of dollars to the people affected by that event. Or consider a charity incubated by Howden, backed by the insurance market, Humanity Insured. Launched last year, it is using parametric insurance to make insurance accessible for those on the insurance front line. With satellite technology, we can now predict when a climate disaster will occur and trigger an automatic payout for those affected. As an example, many smallhold Kenyan farmers are unable to operate without loans from credit unions to buy seed and fertilizer. So when nature strikes and harvests fail, farmers find themselves unable to make loan repayments. But thanks to the efforts of Humanity Insured, whenever extreme drought or excess rain reach a pre-agreed criteria for a given location, those Kenyan farmers now automatically get a payout, preventing them from defaulting on their debt whilst ensuring they have the money to feed their families and keep their children in school. In 3 months, Humanity Insured has mobilised more than $50 million of insurance capacity to help over 1 million people in communities from West Africa to Papua New Guinea. And it's ready to protect 3 million more. Parametric insurance is now so sophisticated that Humanity Insured is supporting an NGO in East Africa to insure themselves ahead of flooding. In future, when extreme rain hits the lakes in East Africa, communities along the river will get a guaranteed payout weeks before any flooding occurs. So they can prepare, move to safer ground, and vaccinate livestock. And this is just a taste of what insurance is capable of. After all, insurance is the foundation stone of finance and governance, and you can't get credit, and you can't release capital without it. But if we could harness insurance's great power, a mighty conduit, you might say, through which the government, the financial industry, and the private sector can unite, then we would have a powerful weapon to manage some of the giant risks we face in tomorrow's world. And the good news is, that isn't just a theory, it's already happening. So let's look at 5 of the giant risks that we're taking on, starting with floods. The past 2 years were amongst the wettest on record. As someone with an interest in property insurance, I find it unnerving to think that 6.3 million properties in the UK are now at risk from flooding, a figure that's likely to rise to around 8 million by 2050. In April last year, the Association of British Insurers said the annual cost of weather-related home insurance claims had risen by a third to a record £585 million. But as we'll hear later on, there's a new flood management project coming on stream that's looking for solutions. Their ambition is simple: to make land available for floodplains, to allow water to flood in the right places, to protect towns and create more natural assets like wetlands, and to reward those who let their land flood with greater insurance and mortgage access. But it's not just flood risk we should be thinking around, but food risk. Food risk is an increasing issue. Howden has been modelling the growth in climate-related agricultural losses in key regions over the coming decades, and we've discovered that some of the key crops in drought-exposed regions could see a doubling of their expected agricultural losses in the next 25 years. This will affect everyone, from smallholder farmers in Central America who benefit from Howden's micro-insurance protection to major producers in Australia, Europe, and North America. The implications in terms of economics for farms and farming regions, never mind food security, is salutary. The protection gap in Europe is 75%, or put another way, that means that only 25% of agricultural losses are insured or protected, and in emerging and developing countries, that figure will be much lower. Not only will that mean that insurance is more expensive, but as financial regulation and credit rating agencies require lenders to evaluate and disclose their climate risks more effectively, access to credit will be restricted. And if that happens, we'll see credit droughts as well as real droughts. So we must not only ensure that we maintain access to credit for farmers, we must also ensure that banks can continue to provide that credit. Again, answers are not a million miles away. In Africa, countries have joined up to create a mutual insurance company, Africa Risk Capacity, to share risk and access to international markets. Indeed, this is just one of the many insurance innovations that have been pioneered over the last decade outside of developed economies, and a brilliant example of how technology transfer from emerging economies to developed ones, and an illustration of how we need to share both risk and expertise globally. Of course, the challenge we face today is broader than just these physical risks. It's also about the need to de-risk new technologies, supporting renewable technology as it powers the transition, which brings me to my third risk, which is energy risk, where creative startups producing renewable innovations often face the same barriers to success: tech failure, credit risk, supply chain disruption. Insurance can help tear down these walls. It can unlock finance for transition, enabling key decarbonisation technologies. At Howden, we've worked in partnership with Aviva to create a construction and operation cover, a policy for solar energy construction service, SunSave, whose aim is to make solar energy accessible to all UK households. Insurance can also promote carbon capture and storage and carbon credit and validation insurance to bring confidence to the carbon market. And both technology and food are impacted by my fourth giant risk, global security. Consider how COVID affected car supplies because of a natural shortage of semiconductors, or how conflicts in Ukraine and the Middle East have hiked up food prices as a result of disruption to international shipping in the Black Sea and the Red Sea. Again, insurance is on hand. At the start of the Ukraine conflict, my company helped broker an insurance for a vessel chartered by the United Nations to alleviate food shortages for hundreds of millions of people in the Middle East and Africa who relied on Ukrainian grain. Our first of its kind cargo war facility was designed to protect vessels from drone and missile strikes by Yemeni-based militia groups in the Red Sea. And the final giant risk I want to touch on is something that wasn't even an issue when I was growing up: cyber. Last year's global outage caused major disruption and an estimated $1 billion of losses, the biggest cyber loss ever, and a stark reminder of our dependence on the digital world. Yet, much as insurance companies forced other companies to implement safety measures for steam boilers in the 19th century, so cyber insurance has made a major difference, compelling companies to put in the correct cyber controls. Our challenge now is to make sure that SMEs, much less likely to have this type of insurance and much more likely to feel the pain of a cyber strike, get covered. Still now, more than half of the business in the UK, well over 1 million private sector companies, have suffered at least one cyber strike in the past 5 years, and the amount of lost revenue clocks in at a whacking £44 million, which is why we've worked with insurance providers on innovative products like Cyber Plus, taking the hassle out of getting a cyber insurance policy and reducing the time it takes to fill out of a form from days to minutes. So in a world of mounting instability, insurance in partnership with others is offering a way forward. But to succeed, it requires all of us in this room, physically or otherwise, to play our part. My industry must continue to innovate and seek to remain relevant. And although I've given you examples of what we're doing at Howden, I know there are many people across our industry, quite a few of whom are here today, who are also looking at how they can play their part. Collectively, we know the insurance industry not only can, but more importantly wants to play a pivotal role in confronting the challenges ahead. But we need governments and the wider financial sector to recognise our potential, no longer regarding us as an afterthought. Instead, we must reimagine insurance, seeing it for what it is, the great enabler, and in doing so, to attract the young talent into the industry that will help us to safeguard the future. And that's why it's fantastic news that the Conduit Club today is launching a new insurance society. A society where all of us, from insurance, from government, from the private sector, can collectively discuss some of the burning issues of our day, broach the toughest of subjects, and devise the most innovative solutions. Together, we can be a force for good, the Beveridges of the 21st century. And just imagine, if we can take on the giant risks of today, from food to flood, from energy and security to cyber, and beat them, what an incredible legacy that would be to pass on to the next generation. Thank you very much.
Thank you, Barnaby, for those insightful words on what this great enabler of an industry can do to tackle the threats that we face and the innovations that are already here. And you'll be hearing more about those that are coming later on today. Our first discussion today looks at industrial policy, how it can help us to be competitive and sustainable, and how we can unleash the insurance industry to help drive that. So for that discussion, I'd like to welcome back to the stage Paul van Zijl with Peter Maurer, the president of the Basel Institute on Governance. Thank you very much.
So Peter is a almost perfect person to follow that really remarkable introductory comments by Barnaby, because he has served in a series of roles which, for reasons he will soon explain, equip him almost perfectly to play the role that he's currently playing at Zurich. Peter was a diplomat. He was Switzerland's ambassador to South Africa, where I got to know him. He then was elevated eventually to become Switzerland's foreign minister. He was the head of the International Committee for the Red Cross, so has spent a life in diplomacy and at the very top of the humanitarian world. Is at the Basel Institute and serves as a pivotal role in sustainability at Zurich. And so, Peter, I'd like to start by tracing what you think the through lines are between your past life as a diplomat and a humanitarian, your current life as thinking about insurance and sustainability in the ways that you do every day.
Well, thanks a lot, Paul, and great to be here. I reflected a little bit what were the sort of key ideas over the last 20 or 30 years when I dealt mostly with fragile societies, conflict regions, and there are a couple of key ideas which I find again now being on the board of Zurich Insurance and doing governance work aside. And it very much ties to what Barnaby made the points in his introduction. I think first, I would say we all recognize that the big problems can't be solved if we don't take a solid preventive approach. Prevention becomes much more important than cleaning up the mess. I think we all agree that the dimensions of problem can be just mitigated or just by money or aid being mitigated enough. So it needs a solid prevention approach. I think the second is that also Barnaby mentioned in his introduction, we are confronted with serious protection gaps. Whether we look at conflict regions, at poverty, at climate change, the big issue is big protection gaps, and we need to fill them, and we don't actually know exactly how. The third issue, which I learned in my past life as a diplomat, that it is good to have global ideas and strategies, but it is even better to have local implementation. And the gap between global thinking, global response, and local implementation is absolutely critical. And here again, I would say insurance is here to help us bridge the gap. And I would say the fourth one is that I got used to as a diplomat that people always lie, don't tell the truth, and reconfigure and disconfigure problems. And I think objective measurement of problems is so critically important to right-size the responses to those problems. Measurability, measurement, data is absolutely critical. And the last one I would mention is that somehow we are in a fragmented world. Everybody talks about fragmentation, but it is also, fragmentation can be overcome if we don't manage to build value chains of how we bring instruments and people and institutions and policies and tools aligned in a way to have better impact. And I think that's a little bit also what Barnaby was calling for in his introduction. How do we align those actors here in the room in a way to produce better impact than we have done in the past?
So I want to come to this question of risk, because in our prior conversations you spoke a lot about how the best humanitarians are people often who seek to minimize and avoid risk in delivering essential assistance to people. And the avoidance of risk is something that you also see in insurance. And I think you have, in our conversations, begun to call for a re-examination of risk avoidance and perhaps a more imaginative and thoughtful embrace of risk at this very pivotal moment in human history. So tell us more about your thinking on that.
Well, I think having a short-term approach to risk is really something which I saw in 10 years at the Red Cross, that it wouldn't solve any of the problems we were confronted with. It would help people survive. That's positive. It's better than having dead people all over. But I think at the end of the day, the root causes of conflict are not addressed by just mitigating superficial risks, whether it is risk to life, whether it is risk from climate change. You can fix the houses, you can fix them 10 times, but what about the sense of what you are doing? What is the strategy behind if you don't go to the root causes of conflict, to the root causes of climate change, to the root causes of disruption in society? And going to the root causes demands a much more proactive way of looking at the toolboxes and the tools and the instruments that we have, whether it is in an insurance sector or in any other sector. I think that goes to what you said in your introduction, Paul, as well. We have these increasing gaps where we think that insurance is not financeable or is not financeable in the way it has been financed in the past. And as gaps increase, we need to be proactive and to rethink on how we can think insurance anew, given the dramatic situation that we encounter with regard to climate change, but also with regard to the dynamics of these multiple and complex risks that were already in both introductions mentioned.
So now let's turn to Zurich. You have a comprehensive framework to think about climate and to think about resilience and to think about net zero. And if you wouldn't mind, just take us a little bit, because in some ways the principles you've just articulated find themselves in how you've gone about thinking about this from the perspective of a globally recognized insurer. So how does this start becoming more practical from the perspective of the insurance company you sit on the board of?
I will immediately jump to that, but maybe start with a story on how I thought more than 10 years ago. I was invited when I was still president of the Red Cross to speak at the 150th anniversary of Swiss Re. And it struck me that the Red Cross and Swiss Re were founded almost 2 or 3 weeks apart from each other in 1863. So what I found interesting is that whether you think about diplomacy, insurance, peacemaking, it's at the end of the day all about how societies deal with risk. And what was in 1863 an adequate way of thinking about risk. And it made me think, what is the 20, 24, 25, 26 way of thinking about risk? And I think Zurich Insurance, what I have seen now as a board member, as many here from other insurance companies, I think we have managed over the last couple of years to adapt some of the products to the new situation with which we are confronted, because we analyze all the same things, all the same data, we see the impacts, and we have modernized underwriting, we have modernized investment policies, we have basically developed the tools and instruments in the logic of how insurance companies develop tools and instruments. And I think many of us in the insurance sector have done really fantastic and interesting innovations, whether it is with regard to innovative energies, it has been mentioned in the introduction, whether it is to the increase of NatCat, whether it is with parametric insurance, whether it is with regard to cyber. I think the sector has innovated and will continue to innovate, and that's good. And I think boards and shareholders and management of companies have pushed that agenda to different degrees, but almost everywhere in the sector, and it has produced positive results. Where I think the big issue somehow is to think insurance more as the sort of last line of defense. And if insurance is the last line of defense, what can insurance do before the last line of defense comes? If the last line of defense is the only one and is increasingly uninsurable, what can we do before? What can we do to leverage our data, our knowledge, in order to define preventive action and preventive policies? How can we advise our customers, commercial and individual, in order to rethink the way they behave and how they define their own investment policies, how they build, how they construct, in order to minimize risks on the way of what we get as a total risk at the end. And I think I would invite and hope that today we manage somehow not only to talk about the necessary innovation of the sector, and it will take some time to discuss these issues and how we make it profitable, and to talk about the dilemma of investing in this sector with the insecurity around. So these are serious issues to discuss. But I would also hope that we somehow think together how we can build resilient solutions out of the insurance sector. We have started to do it. I must say, in my experience coming to an insurance company late in my life, the most interesting discussion I had over the last 2.5 years at Zurich were with the risk engineers. And accompanying risk engineers to the sites, to the front lines on where they do their assessment, has been an incredible experience to me. And I think when you look on what they know and what they see as technicians, that's maybe where we get the ideas. What are the in-between walls of defense that we have to start to create. It's then really about, for instance, to give an example, consulting the city of Madrid on how they can make the city less warm in summer and eventually prevent high level of death rates in a city in Spain. We will see hundreds of cities which will need advice. So it's moving from just being an insurance company to advising customers on what kind of strategies would promise less risk at the end of the equation. And I think this is where I see the huge potential of the insurance sector. Nobody else has the data which allow us basically to define those policies and hedge all those risks on the way, and build the multiple defense structures that we need. It goes into advising customers on how to build. Maybe you don't build a car construction company when you know from your data that the flood risks are high. So you build it in another place or you build it differently. And I think all these advisory services will transform even more than innovation to respond to some of the immediate pressures. It will inform and reform the insurance sector, I'm convinced.
Can you tell us a little bit about, one of the things about the insurance industry, it has these huge pools of assets that it sits on because it takes in premiums, and if it does its job well, it doesn't pay out as much as it takes in, and it builds up pools of assets, and that becomes a source of the bankability and the reliability of insurance. And for that reason, this is a highly regulated space because you want insurers to be able to pay when bad things do happen. So this pool of assets is also could be creatively deployed towards the prevention goals that you've spoken about. And how have you thought about that at Zurich? What do you do? What are the principles that you use in investing the assets that you have?
Well, as a management and as a board of a company, you can, in your investment policy, be more rigorous and set targets of sustainable investment. And we have done that with 6% targets, and we will adapt those targets to what is possible. And I do believe these setting the targets in the different sector, whether it is in underwriting, whether it is in investment in your own operational businesses, it just also unfolds what the problem of capital is. There is a lot of capital here, but also a lot of pressure to invest it short term against profit expectations. Otherwise, you lose your investors. And what I have seen here in dealing in the insurance sector, dealing with climate change, is very similar to what I have seen in poverty reduction and conflict prevention beforehand as well. There is a patent lack of patient capital, which would be deployable to those long-term objectives, because the markets are still short-term. When the big difficulties and dilemmas we are confronting is that the chief financial officer needs to deliver results, and some of the investments into what would be the best way to be a resilient company are have just other time frames attached. And that's the reason why it is not so easy just out of the blue to say we do 1/3 or half of our investment sustainable, because it's also a careful balance that you have to take as a commercial company on how you balance the short and the long term, the profitability with the investment in global public goods, because what you save eventually will not appear in your books, it will appear in other books. And that makes these transformations so difficult.
Can you tell us a little bit about the kind of resilience toolkits? When we were speaking beforehand, you listed a series of things that Zurich is doing in its kind of innovation hubs and what it's doing in its either quest to promote the path to net zero or to think about resilience in a more creative way. And I was struck by how interesting and new that was, and how it was like an innovation lab within an insurance company and didn't feel old school and Swiss at all. It felt sort of kind of innovative and dynamic.
Well, again, the interesting issue from a company's perspective is how you foster the spirit of innovation within the company, and how you basically bring it into a pathway where you honor innovative solutions towards those companies. For instance, in the performance management system, we have introduced sustainability innovation as one of the important measures. When you make it a performance measure, you start to foster innovation, and innovative ideas come forward. It is also, again, the question is how strong and how fast you can encourage those who do traditional businesses to think about innovative solution, and they will think about innovative solution also in terms of the readiness of customers to embrace innovative solutions, to go the way to innovative solutions, to make new business proposals. So as a risk engineer today, you need to calculate and to support your underwriters, and at the same time you have to retool your brain to become an advisor to the customer on resilient behavior. And that's a big issue. It's a big transformation to the sector, to an individual company, but there are tools in order to accelerate and to fasten, but you can't do that alone. You have somehow to be in an ecosystem where customers also push you and want you to come on board. So it's a dialogue issue, it's a vice versa issue. It's really a new set of also engaging with customers, not only as customers to whom you sell products, but also as customers whose needs you want to understand better.
We spoke a little bit about some of the kind of data hubs, or the way that you start using data to think about prevention and early warning. You've done some interesting work around cyber, and that is a sort of major threat. Again, Barnaby referred to that previously. But how are you taking these troves of data that you sit on and orienting them towards prevention in the ways that you've described?
I think a couple of years ago, even before I joined Zurich, the strategic decision is to bring those data in the company together so that they are mineable. And I think the big transformation is really to build those platforms where the wealth of data is usable, also to respond to some of the big challenges. So the big transformation in order to be able to be sustainable is also to put in order your data. And if you don't have them somehow on a common platform, structured in a logic, then you still have it decentralized. And here again, I have been in different organizations doing very different things in my life, and the property of data is still a big inhibitor within companies in order to move forward. But I think we will come to the conclusion individually in all our companies that we can only move forward in resilient and sustainable solutions if we have data ready and available to really also apply artificial intelligence tools and more.
Can you tell us a little bit about the investment decisions that Zurich makes, about what is excluded, what you've decided not to invest in, or if there are exclusions, particularly in a context where in the US it's now, with the fair access rules emerging, companies that prohibit certain kinds of investments get punished in certain state jurisdictions. And so the world is moving against these kind of prohibitions, and what that means for Zurich and how you think about the sorts of things you should or shouldn't be investing in as insurance companies.
Well, in particular, being quite a big commercial insurance, the company has made a trajectory on the one side of excluding the kind of obvious risks from weapons sector to children's work and other things that many or all of us have done in the past, but also to engage on transition policies, in particular with regard to the transition path to net zero. It ties again to what I said before. It's changing the approach to your commercial or individual insurance taker in order to advise them on the transition path, in order to have a landing within what internationally is accepted as a reasonable pathway. So we would exclude the sort of high polluters from insuring where evidence is so obvious that it is contrary to the policies and the practice with regard to fighting climate change and to the pathway to net zero. And we would engage into dialogue and paths to net zero with those customers. So it's a double-edged policy that we would engage to, of excluding the most serious polluters and engaging on a credible path to net zero.
Given that you've been a foreign minister and a humanitarian, I'm tempted to ask whether, in the context of Europe rearming itself in relation to the threats posed by Russia, whether the exclusions on investing in arms are ones that one might want to think about more imaginatively, and whether the arms industry is always a force for evil as it may have been construed in the past.
Yeah, that's a big issue, and I'm sure it will change to the extent that on the continent of Europe also the arms and weapons industry is much more structured dual use, and it's much more a driver for technological change. And obviously the strategic environment in which we are will fundamentally change, and so will some of the assumptions that we have had in the past, I'm sure. Having said that, as a humanitarian and a diplomat in the past, I have my serious doubts whether the best defense industry is just rearming, whether societies need not much more differentiated and much more multifaceted defense systems than just building weapons against whatever threats. I mean, we know it in the past. Much more comprehensive security policy for society is more important than just building up defense industry. But I mean, I see the logic of where the mindset of politics is at the present moment, and I see the logic of your question that whatever changes will affect the way insurance thinks about insurability as well as exclusion from insurability.
So I think this conversation sort of illustrates that insurance has moved from what can erroneously be thought of the sort of sidelines of history. It never was, but it might have been in calmer times, into the very maelstrom, into the very center. Every debate, from arms to climate to resilience to prevention to humanitarian affairs, has some deep nexus to insurance. And I think having a person like yourself steward that conversation is an enormous gift to the industry, and we're so grateful that you'll be joining us today. So thank you so much.
Thank you very much to Peter and Paul. We have a very full house down here today. I can see there are a few people standing up at the back. We do have a few seats upstairs where it's also live streaming, if anyone was keen to take a seat there. We're now going to talk about good growth. For growth to be good, it needs to be profitable and sustainable, but also ethical. And this conversation will focus on how we can use the insurance industry to help unleash that capital and creativity. So please, if you could welcome to the stage our panel, moderated by Rowan Douglas, CEO of Climate Risk and Resilience at Howden. Thank you very much.
Panelists, please come here and take your seats. And huge thanks to Barnaby and Peter for those keynotes. I thought they struck quite a chord. Really sort of took and set up this panel fantastically. Also, a thanks to Paul. The genesis of this event was in the summer last year. As many of you know, Paul makes the Conduit available as a sort of a hub for London Climate Action Week, and there was an insurance session during that early one evening, and Paul happened to come along. I think there were about 30 of us, weren't there, in the room, and we had a really good debate about insurance and how it was sort of the ultimate community product and really a potential agent of change. And I was saying insurance is the big new old idea, and Paul was, riffing with me, and I said to him, I tell you what, this is about a cultural change. And I said, I'll really know that the insurance sector is moving forward when there's, I don't know, a gathering of of folks at the Conduit every 3 months, of politicians and policymakers talking about insurance. And he said, well, you're on. So and this event is really was kind of a testbed for that, wasn't it? And it's great to hear. I think the first Conduit gathering, is it on the 7th of April? 8th of April. Come 7th, because you'll need to get a seat. But 8th. But no, huge thanks to Paul, but obviously critically, a huge thanks to you all for coming. Our sector has got so much to offer. It has been at the heart of a cultural, scientific revolution in earlier centuries, but somehow it hasn't engaged in the last few decades in the mainstream of all sorts of policy and business discussions, not least obviously around climate. So really excited that we're getting out a bit more, and there's exciting people to meet. So thanks for that. I suppose any final thing I'll say, we'll talk a bit about risk. I'm not Italian, but I'm told on very worthy advice that risk comes from the Italian word risicare, which means literally to dare the gods. And it's the concept that we as humanity, and this was obviously a product of the Renaissance, the Enlightenment, had control over our destiny. We had the audacity to think that we could actually imagine the future and take some level of control over it. And it was that philosophical revolution, combined with a scientific revolution of probability and other things, and a political and cultural revolution that led to insurance. And insurance, the idea, risk is, in our sense, defining what it is we value. Assets, homes, social cohesion. What is it we value, and what is it the risks to that value? And the idea that we all will combine resources through taxation or through insurance, premia, into pots of collective resources which are our entitlement if things go wrong. But we have we don't know we'll get that. we're making that available to the community, be it local or global. It is an amazing product of cultural development, and we take it for granted. And boy, do we need to turbocharge that concept in the next few years and decades. And where better to begin that journey than on this panel. This panel is about how can we mobilize the use of insurance to mobilize growth and good growth, whatever that means. Now, we had a great session before this. We had a call, but we didn't say who was going to speak first. So everyone's waiting there. I'm going to start with Claudine, if I may, because Claudine has a senior role at Aviva, driving the sustainability and wider agenda at Aviva, but has only been there a year or two. Two. And came from outside of our sector, but has already been quite an influence in our sector. And I think I was so excited when you joined our sector, because I thought you'll bring all that experience. But why did you choose? Why did you choose insurance for this next big role? But how do you see insurance as a force for growth as well as a force for good?
Thank you. Thank you for picking me first as well. I think bringing that outside in has been really interesting in the past couple of years. I'm a scientist by training, so nothing to do with insurance or the finance sector. So again, that's been quite helpful in bringing that view into the sector. I came to this sector because there's so much potential, and I love making change. That's what I do, and that's what most sustainability professionals do, is go into an organization, a bit like Mary Poppins, and change things, and then move on to the next one, which is sort of what I have been doing. And I think the potential to change here is very much around risk and how the insurance sector sees risk. It feels like, when I've been talking to our actuarial colleagues, it feels a little bit like the yeast in making beer. Everyone has their own formula for that risk in the insurance companies. No one wants to share it because it is such an amazing part of creating value for those organizations. But then we do need to understand how we can change the view of that risk going forward, because a lot of what we do in the insurance sector is rely on data and stuff that's already happened, are less confident to use data about that stuff that's going to happen, and I can understand why, because that data isn't, exactly going to be exact, and the availability of that also is very difficult to find. So my mission is to change that view in the whole sector, not just at Aviva, and to be able to bring that kind of ambiguity into understanding risk and pricing risk going forward, and how we can do that as a whole sector.
Well, I think that's a fabulous mission, if I may say, because while, of course, different insurers and brokers like ourselves who work on behalf of clients into the insurance market, we might have our secret sauce, but it's so important that the key methods and metrics which our sector has pioneered are shared more broadly, so we can all have, if you like, the common lingua franca. It's a bit like, without a shared alphabet, we wouldn't be able to create great literature. We need to open that up, and I think it would be so exciting. So count me in, and I'm sure many in this room to join that cause. Now, I'm truly going to go out of the sector now, because I'd like to come to Claire at the end, because you're truly outside of the insurance sector. You work for Nattergal, which obviously, and not everyone may know Nattergal. I'm sure you'll give people a bit of a description, but it's focusing on nature-based solutions, landscape restoration, with sort of a staff specialist in that, and I guess economists and finance folks. So what brings you to this sort of insurance gathering?
So as you say, Nattergal are a nature restoration business, and actually listening to the conversations this morning, it's been really fascinating for me to see actually how aligned these industries are. because what we do is actually we mitigate risk. A lot of what we do in restoring nature, whether it's tree plantation, whether it's improving soil health, whether it's restoring rivers or releasing beavers, they're all strategies, not tactics, that help to alleviate risk, whether that's flood risk, water scarcity, climate. So nature and actually risk mitigation play very much hand in hand.
Absolutely. And have you got any particular sort of programs, projects, or even asks of the insurance sector?
Yeah, so we spoke a little bit about this before, but one thing that we're coming up against is essentially what we call NatCap. So natural capital is a new and emerging industry that it needs a long-term focus. Restoring nature isn't something you do for a week, a month, a year. It needs very, very long-term investment. And so a lot of the projects that we look at, we're looking at over a 30-year time horizon. And so from that point of view, and Barnaby talked about removing barriers to success, one of our barriers to success is the perception of risk in restoring nature, because it is a long-term investment. It's got a little bit of uncertainty. We've talked a little bit about data. Data plays a very important role. And so I think for the insurance industry, it's what role can they play in helping to mitigate the risk for our investors, so that we can put in place these risk mitigation strategies that look at the root causes of some of the issues that you're dealing with as an industry.
Can I give a quick example?
Please do, Colleen.
So we've just donated 25 million to WWT, Wildfowl and Wetland Trust, and they are creating salt marshes in the UK. And those salt marshes are not only going to be good for biodiversity, bringing back those salt marshes, but also hugely, hugely impactful in terms of flood mitigation. And also, they are sources of carbon sequestration. They absorb carbon. And so we're helping them to develop the carbon code as well for salt marshes.
That's a fantastic example, and I think we might be hearing some more sort of that's the overture to a symphony that Paul is going to be conducting a bit later on with quite an impressive cast of singers and musicians, I must say. So thank you for that, and I couldn't agree more. And partly, how that de-risking of flood risk can be properly accounted for in terms of the impact it will have downstream, and how can that de-risking be properly valued so that actually it creates even more economic logic for doing that, and how is that captured? One of the challenges is, I think, to value that resilience, we've got to know the risk and take account of the risk. Ultimately, this is about contingent liabilities, and once you have to express contingent liabilities, then everything you do to reduce that risk, whether it's through the Wetland Wildflower Trust or insurance, then has an immediate economic value. I think the problem is, and I say this as someone in my mid-50s, it means taking a medical. It means we've got to all go through the medical and actually have the right metrics. What is our blood pressure? Not just a nice chat with the doctor. And if the blood pressure is a bit high, what have you actually got to do to bring it down? Because you want to avoid something much more serious in 5 or 10 years' time. And, like some of us, we might put off going to the doctor, or we might put off going to the gym because we'll think, oh, well, in this another year. And I think we've got to that point where if we can be prepared to take the medical, it'll be painful for a while, but we know the value will be there. And that's probably the key, isn't it? So.
Yeah, absolutely. And then again, I think this was referred to earlier in Barnaby's opening speech, but it's what's the long-term benefit of this for the insurance sector as well. I've spoken to a growing number of businesses who have told me that they are choosing to self-insure against flood risk. And so what's the role that investment in nature can do in actually, again, mitigating that risk so that ultimately it doesn't become an uninsurable risk in the long term?
Yes. By the way, I always slightly concerned when I hear people say, not you in this case, but self-insure. That's usually a euphemism for not insuring, not insuring the risk. So just be careful about self-insurance. It often means you're kind of on your own, and that's insurance is about being together, the ultimate community product. Rebecca, may I come to you? Rebecca and I have known each other a wee while because Rebecca's had a key role at the Association of British Insurers for a long time. And when it came to all the big policy issues and preparing for the COP, I remember the COP in Glasgow. I think we used to have a call every couple of weeks, didn't we, as we were preparing for that and all the related sort of financial regulation that was being driven by Mark Carney in those days when he was UN high-level sort of leader in that area. Now he's even got on to his latest job. Rebecca, you've been at the sort of sharp end of all this and where insurance can play its full role, but also maybe some of the challenges we have as a sector too. What's your perspective on our role as a force for good and for growth?
Yes, so I represent the Association of British Insurers, as you say, and we are the trade association for general insurers and long-term savings providers who essentially are providing insurance products for people's retirement. And in the UK, we have the third largest such market in the world. Our members have, I think, £1.4 trillion worth of assets under management. So clearly there's an awful lot that our sector can do in terms of investing in the UK's transition to net zero, for example. And you know, our members are long-term savings providers. They take quite a long view of their investments, and they're able to sit on those investments for a while, not demand huge payouts in return, but you know, they don't want to play fast and loose with pensioners' money. So I think we see that as a huge opportunity for the net zero transition, which obviously this current government has made one of its priorities alongside its growth mission, for all this infrastructure which needs to be invested in and at scale and quickly. You know, I think it's tempting to see climate change as quite a new and exciting and novel problem, but actually it's something we've been talking about for 20 years or so now. And we know what the sort of technology that will need to be invested in. We know what that is for the UK. If you look at the Climate Committee's carbon budget, which they've just published, it sets out in very detail what needs to be done for electric vehicles or heat pumps. So I think this isn't actually all that sort of new. It's just about getting the right people to take the right risks and to invest in that long term. And applying traditional products like annuities, which are essentially it's essentially just providing a fixed payment in every year of your retirement until you die. Applying those traditional products to these new risks of climate change, and seeing what can be done there.
I think that's such a good point and good example about how we can take some of the existing products in the world of insurance, which insurance has developed over 300 years. All sorts of things have been insured in one context. And sometimes we sort of get a bit narrowly focused on this type of insurance can only be applied in that context. And a lot of this is putting old wine in new bottles. So we did a report with BCG last year looking at the sort of the $20 trillion of investment that will be needed by 2030. This was the the committed investment by 2030 for the low carbon transition around the world. And we reckoned about 10 trillion of that would need insurance. Wasn't quite clear exactly where all that insurance was going to come from, that capacity. Also some new types of insurance. And one of the areas we'd been looking at was carbon capture and storage and the need to scale that up. There was clearly need and demand for that. I remember I'd been in early years a little bit unclear about exactly the role of carbon capture and storage. And I went to a session with Nick Stern at a meeting, and he was very clear with me and others that it was an absolutely critical part of the jigsaw puzzle. So, and colleagues at Howden, we were trying to figure out how to ensure the long-term sequestration of the carbon underground, because it's got to be there forever, but from a legal point of view, it's got to be there for a few decades so that people can fully get the benefit of carbon credits or tax breaks. And that was a concern for investors and developers, And there was some colleagues at Howden who repurposed the environmental liability insurance market, which is usually there to insure against the protection of long-term pollutants after, say, a cleanup of an event, and they reclassified carbon in this sense in its form underground as a pollutant, and repurpose that market to enable the first insurance policies underwritten by SCOR, and I think Liberty, our partners on those particular products, to insure that. And that has hopefully opened up the scaling of investment in CCS around the world. One part of the jigsaw puzzle. There's other elements as well that we've brought together, because a bit like steam boilers in the 1850s, actually, there was real problems with steam boilers. They were blowing up, killing lots of people, but also losing people lots of money because they were at the sharp end of technology, sharp end of innovation, very risky. And a bunch of engineers and insurers got together in 1850 in something called the Polytechnic and created the Hartford Steam Boiler Company, which created the standards for safe boilers, which made them insurable, which then made them investable, which then was the spark that really led to the massification of steam boilers, particularly in the US in this example. And that was it. And that's the same sort of innovation that we need now in all sorts of new technologies, from agriculture to energy, but particularly, of course, in energy. So it's great to discover what we've got already and repurpose it. Much quicker doing that than creating completely new things. Finally, if I may, Anne-Marie, on our call, you were such a fascinating example of someone who knew our industry, but also, if you like, were pinpointing during the discussion, if I may, some of the things that we really had to sort of think about and move on. So I wanted to leave you as the final speaker on the first sort of round of panel discussions, just to give your perspectives on what insurance can do. Because I could tell on our call you were a true believer, but if I may say this, a critical friend.
Critical friend. So is every lawyer. We're the enabler of the enablers, really, because it all comes down to the devil in the details, right? And so I think all of these examples are really fascinating and are great at looking at, what is it that's actually incentivizing people to do one or another thing. And that risk understanding is evolving, right? You're right, it's 20 years old, it should have evolved faster. But I think it is getting to the point where people are recognizing various things. Like you talk about CCUS being recognized and people understanding it. The Earth has been sequestering carbon for rather a long time now. It's kind of good at it. And the laws that are in place that either enable one to invest in those kinds of things or not come out of, I think one of the speakers earlier today was talking about people lying. They don't lie, they just have their own outcome in interest. Laws are kind of the same. They have an outcome and an interest, and sometimes the implementation of them is such that it doesn't necessarily move the playing field in a different way. So for example, in nature capital, right, people are very concerned about whether it is permanent, right? And so the laws are written in a way that says we really need to make sure that it's permanent. I think insurance is a fantastic bridge then to say to people, okay, well, how do I get enough certainty around its permanence that I'm ready to take a bet on investing in it as a product, right? And it's that, the other thing that I thought was fascinating earlier today was the risk assessors. I mean, it's that granular, on-the-ground knowledge from people like risk assessors who can say, okay, this is a real risk or it's not a real risk, because the vast majority of companies and people operating their lives don't have time to get into the details, whereas insurance can get into the details because you're paying out based on the details. So it's understanding that, and to Claudine's point, really getting that information out into the world. Like, these are the things that we'll pay out on, and these are the things we won't pay out on. And here are the reasons why. Because we've done a risk assessment about whether or not that makes sense for our money to be after, let alone your money, which we've collected on your behalf, to be supporting. So I think that's how I would kind of add into the mix.
I think that's a super point to end this first round. By the way, we're going to have another quick round, but really quick, because then we've been sitting down a long time. Now we're into the audience. So please get your questions or observations ready. So maybe 2 or 3 minutes. And those of you who know me know what I'm like. If there's no questions, I will just pick on people I know, or occasionally I don't. So be in control of the risk, control your destiny. You know what I'm saying? Get your hands up. Right. Now, I think that's such a good point, one you made, because in a sense, insurance should be seen as a form of governance. It's a form of governance in all sorts of ways. One is it's a valve on capital. We say that insurance is upstream of investment in credit. And essentially, credit and investment is subcontracted into the world of insurance what is safe, what is investable. And that's such a powerful role for the insurance sector, because yes, we do have all these risk engineers and others who have to understand all these sorts of risks. It could be legal liabilities or what have you, because yeah, we're on the hook. And if the wider financial sector can, and it already happens, but not in the mainstream, if the wider financial sector can work with the insurance sector to be that partnership, that's the real power. But then to make sure that insurance capital is then fully recognized as a contingent asset against the risks that the banks and investors are worried about. That's the magic. So we're both a governance mechanism and a source of the sort of contingent capital that then allows people to invest or loan with confidence, and that's the key. Or to know where not to, which is the other, we don't want to build in the wrong places, in the wrong ways. So I think that's why it's so important that insurance becomes part of the conversation early on, not at the end. And the final thing to say is, insurance is always governed by public policy and regulation. I'm such an insurance nerd, right? That I wondered, how is it that in Britain we all have to have insurance when we have a mortgage for basically all the risks that we face? And if you're British, you take that for granted. You assume that's how it works in the rest of the world. I assure you it's not. In many parts of the world, there's no necessary requirement to have insurance if you're taking out a loan, and it can be quite patchy, it could be not all risks. And it all boils down to the fact, and I looked it up, in 1936, I think it was, there was a clause in some banking legislation that said banks are entitled to require their customers in the UK to have insurance to protect their liability. And that I think it was just 2 sentences in an Act of Parliament in 1936 that means that in Britain we all have insurance, and there was a standard policy that covered everything you need, kind of thing. It's amazing. We did a bit of research. It wasn't fully detailed, but broadly speaking, we think about 70 or 80% of the insurance that you or I buy in the UK is driven by 7 or 8 acts of Parliament or key regulations. And there isn't a single, I think, natural disaster system in the world now, a country, which is purely private or mutual. So always these systems are functions of public-private systems in some way. And so this is why I think the engagement of insurance in the policy debate is also key, as it was in earlier times, whether it was the Beveridge Report, or 50 years earlier, it was Churchill and Lloyd George working together with insurers in things like the Insurance Acts of 1906, 1908. So we've just got to get this back together again, which is what this meeting and this Conduit event's all about. So quick fire questions, and then you know what's going to happen. What do you really would like to see from the insurance sector?
I think there's 2 things, which is first of all the innovation in the products that are available for sectors like ours, for businesses like ours who are creating these long-term nature-based projects. And I know that there's people in the room who are already currently looking at innovation in that sense, but more of it. We need so much more of it to support the industry and the growth of the industry. And there's been many examples of where insurance has played that role in the past already today. And then I think the second thing is just helping your clients understand their nature liabilities and the fact that they are being so overlooked by so many businesses, so many households, and so it's really putting the focus on what's needed to do to restore nature.
That'd be fantastic. And our Nature Supremo, Dan Fairweather, is there at the back, who I'm sure will be very happy to help on that regard. Claudine?
I think for me, it's really starting to really look at scenario analysis and how scenario analysis can help us then define risk a bit better, and not just looking at the normal scenario analysis, which is sort of litigation and the areas that we're used to, but areas we're not used to. So looking at resilience, looking at at nature, looking at different ways of being able to see the world and the impacts that we're seeing, which are not linear, and they're not just one-faceted, they are multifaceted. No one's talked about heat much today. And actually, heat is going to be a huge impact going forward all over the world, including the UK. We'll have health impacts from that. We will have roads melting. We will have EVs that are heavier that will be on those roads that will make that even worse. So it's these multifaceted areas that we don't really look at that I would love to see more scenario analysis on.
I think for me, it's seeing the insurance sector play more of a leading role in investing in the UK rather than abroad in our UK net zero transition. I mean, we as a sector have made a pledge to invest 100 billion in UK productive assets over the course of the next decade. But, you know, there's quite a lot of work that needs to be done to make sure that those projects that are investable for insurers. So working with the likes of the National Wealth Fund to make sure that these blended finance techniques are out there, to make sure that the right actors in the financial services ecosystem take the right risks to make sure that we meet all of our net zero ambitions.
Real quick, it'd be great if insurance could use both its investing power and its data to remind everyone that tomorrow is not yesterday. And what's happening tomorrow is not a replication of what's going to happen, what you know happened. So.
To dare future. So thank you so much to the panel. Let's open it up to the bigger panel, to the insurance curious. Oh, thank goodness, a hand. Please, I think there might be a microphone heading away. Name and affiliation if you'd like, that would be great. And thank you for breaking the ice.
Thank you. Good morning, everyone. I'm Dorota Tale. I lead environmental policy at DBT, Department for Business and Trade. My question to the panel is, how can government play a role in enabling that long-term strategy and long-term view into investment, and in particular into natural capital?
Okay. Picking up a theme.
I think the first point is just being consistent in strategy. I think, you know, governments come in and policies change, and I think that's not very encouraging, and it doesn't inspire basically confidence in the market. So consistency, I think, would be my ask from government in terms of environmental policy.
Yeah, and I think to that point, it's actually looking at the economic levers that are going to help more investment into nature. Because I think nature is going to play a huge part, not only just sort of sequestrating, but also protecting our communities from flood risks. And I think it's a cheaper way to do it than to do it through concrete and cement, and which is what has its own impacts. So making that possible through economic levers, I think things like biodiversity net gain credits, let's keep them on the table, you know, because they are helping that cause, but other things like that.
And I sound like a broken record, but I think making sure that the blended finance is there such that, you know, it's hard to establish who are the beneficiaries of all of these things. You have free riders, you know, lots of people will benefit from this. So making sure that the right people are also paying for that investment. But sometimes that isn't possible, you know, there will be market failures, and that's where you need government to step in to act as that sort of conduit to make sure that the blended finance, the right risk is taken by the right people.
Yeah, well, since we're going down the list, all of the above. Consistency, clear directionality. People can't invest into confusion.
Can I just add one more? Planning regulations, please. Making sure that we're not building on floodplains and things like that, and making sure that when we are building, we're building it in a resilient way.
And the other way, of course, is to join the Conduit Insurance Society. So great that our first government department is part of that. Marvellous. Right, I'm going to take one. I'm going to go over here first, but I see a forest of hands to my right. Yes, there's I think a lady behind the, as far as I'm looking, behind the pillar there. Thank you.
Hi, thank you to the panel. That was great. I'm from a company that works with sustainable startups, and it's been touched on, but I just wanted to ask what role insurance could play in supporting SMEs, producing innovations and technologies for green growth, especially in sectors like construction and other high-risk industries that are dealing with a lot of change from extreme weather events and things like that.
Should I go? Yeah, interesting that you raise things like construction. Look, I think data, it's been talked about, nobody has better data than insurance companies, and I think that's one role certainly is helping people understand the risks and the opportunities themselves. But like I said, it's continuing to innovate. Anna Maria put it very well, the history we had is not the future that we're facing, and so continuing to think about really innovative solutions that are supporting the growth of these SMEs and these new industries.
And as insurers, we also invest. So we have a venture capital fund that invests in new startups. In fact, we invested in Nattigal recently, but we do invest in lots and lots of other organizations that are starting up in this space.
One area of insurance that not everyone is aware of is what's called technology performance insurance. And it's really developed when a technology or a process has got through the initial invention stage and maybe even the piloting stage. But now you're looking to actually sort of scale up, and you need to scale up, and to do that you need to have customers who are prepared to take a bet and buy it. You also need maybe investors or creditors to give you the oomph to scale up production. And there's a chasm of sort of, it's part of the valley of death, isn't it? And with some technologies and some processes, insurers are prepared to guarantee the performance of that technology within parameters. It's quite a well-established market, and actually there are now specialists working in the low carbon technology space. I don't know if that relates to your space, or but again, there are other markets. I know it's slightly different, but in the world of carbon credits, we've developed a policy to help protect buyers of carbon credits, and it's actually deploying something called the warranties and indemnities insurance market, which was traditionally part of the market that guaranteed the commitments people made when they sell their businesses in the M&A market. There's another related part called surety. Essentially, there's an insurance market to allow people to insure the promises that they're receiving, or indeed they're giving. And so I would just say that in your area, there is actually quite a bit that can be done potentially to help you and your stakeholders use insurance to bridge some, I'm sure not all of those areas. We've got 10. Thank you for that question over there. I'm going to head over here now. Thank you. Right at the back. Thank you.
Is this on? Yeah. Hi, good morning. My name is Camila, and I work for TMP, which is a climate consultancy. And my question is more addressed probably at Anna Marie or Claudine, because you've mentioned risk assessments, data, and yesterday is not tomorrow. And I wanted to know specifically what are the challenges that the sector is facing when obtaining, analyzing, and implementing measurements for prevention when it comes to specific and immediate climate crises that are upcoming.
I think one of them is just variability, and obviously future, trying to forecast the future, especially with the models, are kind of all over the place. So you can get a model that's telling you that it's going to be a 1% hit, and you can get a model that tells you it's a 20% hit. And so what on what criteria do you apply the data in the models to assess the risk, I think is probably the hardest one for people. And I think the other one is just people are used to doing things in a certain way, so when they have to do something in a different way, it's also a little bit it's not as easy as if you can just take out last week's assessment and kind of update the numbers.
I think the other major challenge is it's an annual. All risk is accounted for on an annual basis, because all the premiums are on an annual basis, and you pay out on an annual basis. So the whole business is built on 1 year kind of estimations, and that makes it difficult as well.
I think one of the things that we'd love to bring together is a lot of the insurance sector does work on a one-year basis, you know, home insurance. But actually, a lot of the insurance sector works on a very long-term basis. Life insurance, health insurance, you know, these are... And what we want to do is sort of bridge the short-term extreme expertise with the long-term expertise. You know, why shouldn't we have infrastructure life insurance that would, you know, last for 20 years as long as you looked after the infrastructure, did certain things. And there are huge challenges, of course, in understanding, in this case, climate-related risk. But I would say, compared to most other classes of business that insurers have to worry about, climate is probably the most predictable. You know, it obeys the laws of physics. We know where it's going. You know, look at some of the changes that have happened in the world in the last, you know, 6 months. We face much greater uncertainty in most other areas of our business and professional and indeed insurance life than actually this particular area. So there are uncertainties, but I think that often the risk modeling isn't the most fundamental challenge. It's finding ways to allow people to feel comfortable paying the price of risk or appropriately sharing the price of risk. And I think that's going to be, you know, probably an even bigger challenge. I think we've got time for maybe a couple. What I'm going to do is, if it works with the microphone, I'm going to take 2 or 3 questions to get the questions in, and then the panelists can take whatever question they like and any final comments. So I think I can't see with the lights, but I think there's a gentleman there. Thank you.
It's Harmender from SCORE, which is a reinsurance company. So a key component of growth is investment, and there can be a reluctance to invest because of a lack of mandatory standards. Do you think insurance can play an important role in creating standards and therefore confidence in investments?
Perfect, thank you. Hold the answers quickly. I think I saw a hand up there. If you don't mind shouting loudly. Oh, we can get the microphone there quickly. I don't know that I need a microphone. There we go.
Isabel Cohen from Nature Finance. We've heard a lot today about insurance as a kind of market-making endeavour, and we've also heard a lot spoken about in terms of resilience. Though we're currently economically and politically committed to 2 to 3 degrees of warming. So I'd like to understand what the panel thinks about the role of insurance in adaptation and more generally today.
Fantastic, thank you. So we've got one on standards, one on adaptation. I did see a forest of hands. They've gone down. No, they're coming back up again. Thank you.
Hi, my name is Inge Relf. We have a foundation called Global Choices. It seems to me we have a massive lack of prioritization though in the risk. We're doing an awful lot of activity in different things, but we are missing perhaps one of the greatest risks, which is a systems risk from the loss of the polar ice, both sides. And because it's not monetizable in the easy way in terms of getting carbon credits, and of course markets veer to that and still look at that aspect, and I'm not ignoring that it's a business, but I've been very heartened by what I'm hearing about the insurance industry's ability to be really creative, but also look at the interconnectedness and the interdependence of what we are facing, and how we can value things that perhaps we haven't even thought about valuing in the past. And it's not only monetary value, but our human values. And I think that brings us back to where you were originally, about what insurance was based on. You know, what is the purpose of this? We could make all these wonderful underwriting and make good money, but on the other hand, we can lose it because we haven't prioritized the things that we actually haven't understood as being the main drivers of the disasters that we're facing and the way those very quickly can unfold. So I think I was very heartened by what Peter was saying in terms of, you know, understanding all the interconnectedness of it, the geopolitics, the migration, food security. If you actually look at science of causality, that comes back to systems like the Arctic and Antarctic.
Super, thank you. I was looking at the wrong clock. I thought we had 10 minutes left. We've got 2 minutes left. But anyway, thank you so much for that. That's about retraining the invisible hand, I think, which was super. So any answers, observations on that? Final words? But thank you for all those interventions. They were fantastic.
I can give a final word in answer to the standards question, and that's yes.
On the adaptation and resilience, there's a huge amount of work going on in terms of adaptation and resilience in the sector. I mean, Aviva, we've just given £87 million towards nature-based solutions, and that was a donation to recreate things like rainforests, etc. We haven't got long, so I won't go into that too much. But where there is a huge amount of work going on in that space.
Yeah, it's lovely to see that there used to be a wee bit of a tension maybe between the low carbon agenda and the adaptation resilience agenda. It all seemed to me to be a false choice, and it's lovely to see both areas now becoming equally highlighted.
Build Back Better as well is a really good example.
Yeah, exactly. Rebecca, any final?
Yeah, I was just going to actually raise Build Back Better as well. I think we're going to hear from Flood Re later today of, what happens when, for example, a building is flooded. How can we as a sector, instead of just returning to as it was, which is sort of how traditionally insurance works, how can we build back to a standard which, if it does flood again, you're more resilient to that?
And to Claire, our critical friend, the final word.
Or Anne-Marie.
Oh, sorry, Anne-Marie.
No worries. I've been called lots of things. I think it's, all of these are great questions. There were like tons over there as well, I'm sure. I think it's about making sure that when you're looking at insurance or looking at rebuild or looking at whatever you're doing or looking at the laws, you're thinking about them critically as if you were starting the system today, right? Instead of, and lawyers do this all the time, we build on what's there because that's the easiest thing to do, and precedent drives a lot of things, and I get that, but you have to kind of push that mentality to, okay, well, if I was going to start today, what does it look like, and how far can I push the precedent to what I would like to have started with today?
Well, there's never been an insurance event at the Conduit. We are thinking new and thinking fresh, and with that, hand to the to the panel. Thank you, Emma.
Thank you very much to Rowan and to our panel. We heard a little bit there about resilience, which leads us quite nicely onto our next panel. Growth, good or otherwise, is always going to be hampered if we don't have resilience to climate shocks, to floods, to heat, to societal upheaval, to cyber shocks and financial shocks. So, leading the conversation about how we can build resilience into our society and our economy, please welcome to the stage our next panel, moderated by Sarah Stefanini, the EMEA Policy Editor for Carbon Pulse. Thank you very much.
Hi, thank you very much. I'll just wait for all our speakers to join. Yeah, so we're going to look now at building resilience for society and economy, and basically the role of insurance here in sort of helping to not just build back what is lost in a flood or a fire or any other kind of catastrophe, but also building back in a resilient way so that hopefully when the next flood comes, a house or a business won't go through the same kind of destruction. And so we are going to kick it off with Jonathan Day, Deputy Director of Risk Assessment and Research, Flood and Coastal Risk Management at the UK's Environment Agency. Over to you, Jonathan.
Okay, thank you very much. Morning, everybody. My name's Jonathan Day. I work for the Environment Agency, and I'm responsible for our flood risk assessment work. So that's our national scale flood mapping and all the models and data that underpins that. And that's really important to us as part of our flood and coastal erosion risk management strategy. And our strategic vision is around building a climate resilient nation. The language is really important. We used to talk about protection and defence, but obviously we can't eliminate flood risks, so we have a more balanced strategy now where protection sits alongside preparedness and response and recovery. And our work with insurance is absolutely fundamental to that, particularly on the recovery side of things, because obviously a flood-affected community that doesn't have insurance takes much longer to get back on its feet. So that's really important. And looking back, the UK has actually been unusual in that insurance has historically been available as standard on home insurance policies. That doesn't happen necessarily elsewhere in the world, and even before the establishment of Flood Re, that was kind of the case through a gentleman's agreement between government and the insurance industry, whereby it would be a case of if government invests in flooding, then the insurers will keep insurance available. But an observation from my point of view is that when we develop our flood risk assessment and when we find out more about present day risk and especially more about how that risk might evolve in future, this kind of relationship gets stretched and challenged. And that's really relevant to us at the moment because a few months ago at the Environment Agency we published a landmark update of our national flood risk assessment, and we're including a much better representation of flooding, much more detail, and for the first time we're including mapping showing climate change impacts. And I think this brings sort of opportunities and risks, opportunities at all levels, whether it's to think about sort of proactive management of flood risk, so that could be, you know, householder thinking about property level flood resilience measures based on perhaps relatively shallow flooding in their area, right up to financial institutions thinking about exposure to climate risk. So lots of opportunities, but actually threats as well, because it worries me that I hear increasingly people talking about being refused insurance, and particularly, for example, in basement flats who are leaseholders and not covered by the Flood Re scheme. And I do worry about how that's going to play out in future, and the transition to a risk-reflective pricing system, which is meant to take place in about 15 years' time. I can imagine that there are some quite big risks in that. So I think it'd be great to have a conversation today about how we continue to work together to think about those long-term risks.
And with that, Alex Bedford is Customer and Partnership Manager at Zurich Municipal. She's replacing Amy Brettel, who is very, very sorry that she couldn't make it. But from the insurance industry point of view, how are you responding to these changing risks, and what does the industry need to do differently?
Thank you. We're really happy to be here today. And actually, the first thing we need to do differently is have way more of these kind of conversations. That's a key point here. We find that we're often brought in at the end of processes when resilience measures have been decided, but the insurance angle hasn't always necessarily been taken into account. It's been assumed. Which it can't be anymore. So conversations early and often is a key ask from us as an insurer in this space. The other point for us is, so I actually work, and Amy is the managing director of a business unit within the Zurich Group, Zurich Municipal. We are a public and voluntary sector facing business unit. So we insure local government, education institutions, housing associations, charities and voluntary organisations. So the social resilience side of what we're talking about is really important. Property resilience, yes, but actually what those properties enable people to then access and do, what it enables our customers to serve those communities with. So that social and human impact of lessening resilience is something that we're really keen to always bring to the table, even when we're talking to our property underwriters. Actually, there are people at the end of these conversations that we really can't lose sight of. So we're very happy to be here, and more of these conversations, please.
And John Willis, Senior Director of Aligning Finance and Value at WBCSD. So how, looking at it from the wider point of view, how do you see the insurance industry changing or not changing in response to climate change, and what should be happening?
Yeah, thank you, Sarah, and thank you for inviting me here. In fact, I'm coming back home because I've only been with an organisation with one of the longest acronyms I've ever come across, World Business Council for Sustainable Development. But previously, I was with the Tracker Group, that's Carbon Tracker and Planet Tracker, and we had the pleasure of working upstairs. And it was a great networking place, I have to say, because I would always say I've got a bar above me and a bar below me. And that was very, very good at attracting people. I used to pretend they wanted to come and speak to me. On insurance, interesting, as I say, I confess I've only been with the World Business Council for Sustainable Development for a week, but I got absolutely hit straight away because they're setting up a physical risk panel, and the interest from corporates is through the roof. And actually, it should be. There's been a number of comments that have completely resonated with me in previous panels, and one that I just thought is so right is insurance must not be treated as over there or alone. And I sort of went through this with the NGO community, and people would say, well, you're for a finance background, because I used to work for the investment banks, and they would sort of politely walk away. And I always felt sort of insurance and pensions, oh, you do pensions, or you do insurance, you know, sort of walk away. But it's everywhere. It really is everywhere, and you can watch this playing out. So just a couple of things to look at when I said it. If you are a corporate lender, you have to be thinking about insurance. Are you lending on assets which are uninsurable? If you are a director of a corporate now, and you have either built assets or are building assets which are becoming uninsurable, what are you going to do as a director? You really have to start thinking very, very hard. What if you're an equity holder? What if you are a shareholder in these companies? And I won't go into it now, but you've got to look into the detail of how corporates are going to deal with that. So some are going into pools. So as an investor, are you going to be invested in a company but is actually insuring something somewhere else? These affect the financial markets, they affect our business environments, so we're very much integrated into the insurance ecosystem.
Thank you. And Alex Woodman, Chief Fire Officer at the Hertfordshire Fire and Rescue Service and Chair of the Local Resilience Forum and member of the National Fire Chiefs Council. So we've heard a bit about floods from Jonathan. How do you see your work changing? What is changing in terms of fires and risks of fires, and what is the role of insurance in that?
Good morning. So I think we tend to cover a lot of the same ground but at different phases, and I don't think has been around its ability to do prevention. Success, if I look at fire and rescue, probably over the last 15 years, has been around its ability to do prevention, but I don't think we're aligned enough across the UK and what that means. I don't think we harness enough of the skill and knowledge across the private sector, and I think we're too distant in the public sector. We're focused on response, and we put a lot of emphasis on that, and our public services are good at responding. The area that I think we need to enhance, particularly with the skills, the knowledge, the analytical insights, the data, the modelling, the wider views that insurance sector can take, is something that I don't feel we harness enough across the UK from a response side. I think there's also a bit of a danger of the glory as well of response, and we don't think about the hard yards in being prepared for stopping, modelling, preventative work. And I think when I speak more stepping outside of fire, but the work of local resilience forums, their core being should be around being into prevention. But I think sometimes we look too local and we don't think big enough about the collective strength that we can do around our wider prevention strategies. So I think the angle for me is very much around making sure that we have a genuine round table of system players in prevention, but that also flicks to a very strong response that we need in response, because many players in this room will be part of that response when it's gone wrong. We can't lose sight of it going wrong, but we need to do more when it comes to our prevention arms and coming together as a system.
Thank you. And finally, Emma Howard-Boyd, currently Chair of Client Earth, but formerly Chair of the UK Environment Agency, and also formerly a board member of the Department of Environment, Food and Rural Affairs. I mean, what is the government's role in this? And your thoughts on how insurance is changing and what insurance needs to do?
So I want to build off what Alex has just said in terms of the role of first responders to some of the events that we are talking about and building in a longer term response. I also chaired the London Climate Resilience Review for Sadiq Khan. And right from the get-go, it was called the London Climate Resilience Review, but it was commissioned by the adaptation team, and therein lies some of the issues that we start at, whether it's at a local authority level, whether at a departmental level, whether at a corporate level, whether at a national government level, that we are putting this subject, this incredibly important subject, into too many different boxes. And it's very, very clear from the work that I've done, both as chair of the Environment Agency, but also chairing the London Climate Resilience Review, that we need to go from first response. And again, some insurance companies have got some amazing programs of supported those flooded communities, those communities suffering from other climate impacts. But more needs to happen. And if you go back to what inspired the London Climate Resilience Review, which was the extreme heat of July 2022, you started off with prolonged dry weather, then a heat wave, which meant that there was stress on water use. Water usage went up 50%. When it came to the ring of fire that surrounded London, there's one part of London where when the fire brigade went to put out the fire, and it was the busiest day for the fire brigade since the Second World War, the water pressure was down. Think Los Angeles earlier this year. And then what often happens with a heat event is that it breaks with extreme rainfall. And one of the things that the National Assessment does very well, the Environment Agency data that was also, I think Barnaby drew attention to it in his opening remarks, is surface water flooding is dealt with by local authorities, whereas river-related flooding and coastal flooding is led in England by the Environment Agency. So there is a real importance of putting attention on bringing together the different players on this subject to discuss real long-term solutions. But I want to put some urgency and attention into right now, because right now our government in the UK is looking at its spending review. And for those of you who have looked at detail in the autumn budget and look at the different departmental settlements, one of the things that it says very clearly right now is that the flood budget will be under review because of the financial pressures that exist. We're at a really crucial moment. Claudine talked earlier about heat. That this is just one bit of the climate resilience budget for government. We need to make sure that collectively we're not going backwards on the flood budget, so that we can do the work that is needed there, but also the work that we need to see happen on other climate resilience areas. I think the other final point that I want to make as former chair of the Environment Agency is when government funds flood defences and takes an area of the country from being at extreme risk to being protected, there needs to be some way of sharing the growth that comes after those flood defences are put in place. And this is where the business community and the insurance industry can help, because it's all the same money, but that's coming from taxpayers. But ultimately, and various speakers have talked about the need for the insurance industry to make profits, but some of those profits also need to be shared back with communities and governments to make sure that we are not just seeing government fund the defences, but there's some money coming back to government to allow more to be done. Thank you.
Thank you. So Emma started to do this, but I was going to ask Alex and Jonathan to sort of paint a picture about what is the change that you're seeing in terms of natural disasters. I mean, everyone can picture the California fires. Everyone can picture some of the recent floods in the UK. Alex, in your work, you've been in this line of work for a long time. Are you really feeling and seeing change in terms of fires and risks? And same, Jonathan.
So I think if you look on your TVs, it's pretty evident the impact, specifically around climate change and what it's having. Our response to flooding, our response to fires, particularly, who would have thought we'd have wildfires in London? It's not the type of headline you think we'd ever have. To put it into a bit more context, those extreme heat and the wildfires that we saw during that summer, I ran out of firefighters in Hertfordshire. We were at the point sitting in our control room where every one of our fire engines was committed, every firefighter was committed, and we had every one of our on-call service at 100% availability and committed. Decisions by my commanders were being made to release asset to come into London to help because of life risk calls. So it couldn't be more real about what is happening. And I think if we move on to the flood side of things, I think also the understanding of roles and responsibilities when it comes to flood, because the role of the fire service in flood is somewhat limited. Most people think it is the role of the fire service to go out and deal with flooding. I won't get into major debate today, but there is a technical point that we don't have a remit with flood. We will deploy asset and if there's life risk, but just understanding that surface water flooding, which becomes a major impact. We're seeing more rivers in Hertfordshire flooding that haven't flooded for 50 to 60 years. We've got a couple of live flood risks at the minute that we're looking at. We're having conversations that these areas haven't flooded for over, I think one of our areas is 65 years that no one's had it. So people have lived in their homes, their properties, their whole lives, but they had no idea that this was a flood risk. These things are happening live as we speak. So it is a real changing dynamic for us in what is happening to our type of response.
Yeah, simple answer. Are we seeing changes? Yes, I think Alex has painted a really a good picture of that already. Over the last few months, over the sort of winter storm season, we think around 5,000 properties probably flooded across England. That would, in maybe a decade ago, that might have sounded like quite a bad winter. I think that's just pretty normal now, and every season, if you want to call that a flood season, although flooding can happen obviously year round, we are seeing sort of record water levels somewhere in the country. So yes, it's changing. I think the sobering thought is in the future, I think we'd be doing very well indeed if we manage to keep the sort of national level of flood risk at present day levels. It's likely to get worse. I think we need to also factor that into our conversation.
Can I jump in on powers? Because I think it's not just something about powers to relevant agencies, it's also to whether this is dealt with at national government or local government. And the work that I did with the Mayor of London, but also with other mayors, not just in this country, but around the world, getting the right powers and responsibilities, making responsibility for climate change, adaptation, resilience, statutory, means that you have to start allocating money towards this, but also allows different levels of government to raise money and work with the private sector to bring in those different ways of financing the work that we so desperately need. Thank you.
Thank you. And in terms of working with the private sector, Alex and maybe John also, how do you reconcile the fact that insurance is also a business and insurance companies do want to make money, but in a way, there's a public good that they need to provide too and a societal benefit? How are they dealing with that?
So I'll go first as the insurer on the panel. So absolutely, I think that's the whole point of this, and particularly in our little part of the business, that balancing is absolutely critical. So we are working with publicly funded organisations, or whether that's through government funding or through donors, or investors in the charity and voluntary space. So we need to do good while also doing well, to steal a phrase, because we have to do well, because we need to be there to pay claims. But to keep that manageable, we need to be working with our customers, with governments, with partners in the room. We've talked about pre-event, so extending the life cycle essentially of how we're thinking about resilience. So a long time pre-event, so you're planning, you're making those connections before you need them. But also recovery, you've talked about response. Recovery takes a lot longer than response. So anything we can do to think about beforehand mitigations we can put in place that can speed up the way in which we can recover, will only help those people who are experiencing the floods or the fires or the heat that the climate changes are bringing to us. So in terms of how we can support that, I think the whole sector has been very much looking at our end-to-end proposition around that. So we are not just there at the point of claim. The conversation needs to be starting a long time before that, and it needs to be extending a long time past that, so that when we are responding, Build Back Better's been mentioned, we now look at the sort of human impact of something like a flood. So it's not just about getting you back into your home, if you're a housing association tenant, in our world, or back into your school to deliver education. It's actually how do we use our expertise and our supply chain to do that in a more resilient way. So if you've had a water ingress, cages on gutters, real simple stuff that doesn't have to cost a lot of money, but we can bring in that expertise so that you can continue in a much more resilient way, because the same thing will probably happen otherwise. So it is a shift in how we are looking at our proposition and our end-to-end support.
Thank you, John.
Yeah, thank you. Let me stir things up. I do think that business has to be very much part of this discussion, and I'm going to just give a couple of examples. So one is, I'm now going to jump on the side of the insurance companies. I think it's very easy for us to say to the insurance companies, they don't always, you make a lot of money, share it around with everyone else, but they've still got businesses to run. And one of the issues that they have, you can actually see within their business. So they've got an underwriting business providing all of this protection, and they can also have an investment business. And a question came up earlier about, well, in your investment side, and it was well dealt with by a very skilled diplomat, on your investment side, is it all sustainable? On the investment side, their job is to make returns. And those returns are of value to all the insurance markets. So ideally, you might want all of those returns to be sustainable. I'll guarantee they won't be, because that's not what those portfolio managers are paid to do. They're paid to get the highest returns, to get the reserves for the insurance companies so they can meet all the regulatory requirements. I'd also say from a business point of view that actually businesses are going beyond just worrying about property. There are indirect risks with wildfires and flooding, etc. And that can be, let me give an example, Brazil. A very big bioeconomy, one of the biggest exporters of food commodities in the world, and there's very interesting academic research about how some labor productivity is falling because of heat stress. People are finding it difficult to work in those environments, okay? So think about other indirect impacts. One of the issues now being discussed in California, and we've got a relationship with Stanford University there, one of the issues they're worrying about is housing for employees. So if they're in the cheaper housing, which you can't insure, are you going to be in that housing and go and get a job? So suddenly they're worrying about labor resources. And then finally, a conflict that I had to deal with in my previous job at Planet Tracker was we were examining oceans, and there's a thing called IUU, which is basically illegal, unreported, and unregulated fishing. And we were talking to insurance companies who actually were insuring these vessels, and you go, well, why? You shouldn't be touching it. And they're going, yeah, but these are the most vulnerable people in society. So are you telling us not to insure them? So all I'm trying to indicate is these conflicts that exist, but business must be part of the solution.
Alex, you wanted to come in?
I was going to make a bit more of a blunt point as well. I think sometimes we need to get over ourselves and look at our governance arrangements, because I think we're very good at telling each other why we can't do something. But what I don't think we do is enough of coming together and looking at the system. And that's why I'm trying to step away. As an LRF chair, I'm a neutral individual. I don't represent individual agencies. I represent the system of Hertfordshire. And in turn, I'm trying to bring together some of our LRF chair, or all of the LRF chairs across the UK at the moment, to have a conversation that looks at how does the system work. And I think that's the challenge back to everybody in the room of how do we come together. We come together and talk about a problem and what we're going to do about that problem. But actually, most of what we do as a collective system can be mapped across any of our problems, and I don't think we do enough about challenging our governance arrangements and harnessing or leveraging the power of the system. And I think that's something that's just an important focus. There isn't, government has a strong convening power, LRFs have a strong convening power, this forum here today has a strong convening power, but it's what we do about making sure that we operate as a system and don't point at each other around responsibilities. And I don't think we're good enough at doing that. We're very polite about it, but we need to be more blunt.
Thank you. And I think that is a fantastic point, and it links to what regulators need to do as well. So I've often said environmental regulators need to work in lockstep with economic regulators, financial regulators. We need to go to those places where we need to hold the mirror up and ask us, are we really doing enough with what we're doing on the insurance side versus the investment side, whether it's in insurance companies or pension funds, and we have to start acting with that. Can we go to those difficult places and see if we can unlock that real urgent action that we need? And I think some of those solutions often lie in places absolutely at the forefront of the extreme events that are being experienced right now. So whether it's pulling climate change into the finance departments, as we've seen in certain governments in and around the world, when we look at some of the solutions and job creations that I've been able to see as in my role as co-chair of Climate Resilience for All, where you're bringing together different partners, including philanthropy, including the insurance industry, to create new kinds of micro-insurance products which pay out when so people don't need to work in extreme heat. These are the things that we need to see happen quickly and scale up so that we can really deal with some of the big issues that are happening right now and not in the future. Thank you.
Thank you. We're quickly running out of time, and I will open it up to questions. But I also wanted to ask, possibly for Alex in particular, how is risk modeling changing, and what is the insurance industry? We're seeing increasing record-setting days of rain, heat. Last weekend was record heat in March, at least in Brussels, where I was. How are you taking that into account as an insurer, and how is it changing what you're doing?
Okay. So one of the superpowers, I think the phrase was used in one of the earlier sessions, that we do have is climate modelling expertise. We have a lot of data. We put it together in ways that make sense for us. In terms of our insurance book and our investment business. So we have our climate modelling focused in those two areas. And I think, again, talking about in-year analysis, we absolutely are looking both in-year and long-term. Again, we are widening the scope of where we're looking. What is interesting is a lot of challenge I get when I'm out talking to our customers is, can we have your data, please? But as I said, the data is modelled in a way that reflects the questions that we are asking ourselves as an insurer and an investor. You may be asking different questions, so the data is a different set, or you need to look at it in a different way. Data needs to be understood in context. It's a really important point here. And we are looking at developing the sort of climate modelling capabilities that we have into more customer-facing solutions. So there's a climate spotlight tool that has been launched by Zurich's Resilience Solutions arm. We are piloting it with Surrey County Council in the public sector amongst the Zurich municipal customer base, just to see if it works. Data is not always a panacea, and I think sometimes we're at risk of thinking it is. We're chasing it all the time. So we are constantly evolving our own climate modelling capability, because we are learning more and more. The science is becoming more and more sophisticated. The reforecasting is constant. But also looking at how we make that more publicly available so we get more of a shared understanding of risk profiles to make conversations, convening conversations easier.
Thank you. So Jonathan would like to come in, but I will just ask, if you'd like to ask a question, maybe raise your hand and get ready so that then we can move straight on to that.
Yeah, it was just very quickly on data to say it's important to us. Our flood risk data is all open. We have a digital service called Check Your Long-Term Flood Risk. That's just been upgraded to carry our new information. So it's really important to us that we raise awareness of risk and people learn more about their risk. And it is one of our challenges as well, because actually the reality is that I think in our surveys, maybe only 30–40% of people who are in flood risk areas are actually aware of their own risk. And that's something, perhaps one of those gaps that perhaps the insurance industry can help us with. Another one might be, can insurance incentivize risk management behaviours as well? So,
John?
Yeah, just very quickly, I just want to say, I mean, the insurance companies, a number of them seem to be very, very accurate in their models, so much so that you had a Californian regulator telling them not to use them, so they withdrew from the market. So that's now been stopped because that was absurd. There was a question earlier at an earlier panel more about tipping points. That is much more difficult. There's a lot of work being done particularly at Exeter University on that, and that is tricky about the effects of that. But near term, it seems they're getting increasingly accurate.
Thank you. Any questions? And please introduce yourselves.
Hello. Hi.
Yep.
Chris Lynch from the National Trust. One thing that hasn't been talked about a huge amount today so far is climate adaptation. Emma kind of touched on it a little bit. But if resilience is the outcome that we're aiming for, then adaptation is the process to get there. So I'm curious, particularly from John and from Alex, what more business and the insurance sector can do to galvanise action on that. And specifically, Alex, for example, you work with public sector organisations. They are obligated to report under the National Adaptation Programme. Would expanding that to private businesses, for example, be a route to do that? Thank you.
Yeah, let me just give you an example of adaptation, and I think you're going to see more and more of this. If Miami, everyone knows, is at serious risk of flooding, and what's been happening along that coast is actually an alliance between some of the insurance company and real estate. And what the economic judgment they've made is that on some of the property, they're actually not building. And they've created, I don't want to go over the top, like a mini floodplain. So if the water rises, it's not actually reaching the property. So they go for parkland. Because of that, the insurance companies are willing to lower the premium. That's very attractive for the real estate developer, who will sort of sell that messaging. And that's how I think, so I'm just giving you one example of how adaptation can actually work really effectively and is in practice.
So in terms of adaptation, so I was involved in a rapid adaptation pathways assessment plan workshop recently, RAPA for short, an area that is subject to tidal fluvial flooding, and for the first time, everyone involved, from individual residents to British Nuclear, who had to the railways, were in the room, and so were we. The value, so as we were going through different adaptation options, then sort of basically coming to us for a bit of a view of, if we do this, will you? Rather than, we are going to do this, this is the best option, and then bringing the insurer in at the end and then asking lots of difficult questions that put everyone a bit on the back foot. So adaptation is the way. Understanding what adaptations is going to help an insurable risk is key there if we want to get bang for our buck around the investment that we're making in them. The other point around that is also, we have put adaptations in place that then aren't maintained. So thinking about the longer term plan, so that we're not constantly having to reinvest and find new money for extra or future adaptations or repair of adaptations. So yes, adaptation, building the adaptation journey so that we reach a point where we are more resilient needs to be the journey we're all on. But bringing insurers in, if we want insurance to be part of that resilient solution, as I say, at design stage, it would be great.
Thank you. We have time for one more question. I see a microphone up there. Go ahead.
Julian Richardson, Chief Underwriting Officer at Munich Re, Green Solutions. I'd like to pick up on Alex's point around the profitability of insurance and the role of the private sector and private insurance here. You know, John, you made a really good point about the insurers pulling out of the California market because they were not allowed to make profit. And that is a very real thing. At the end of the day, it's a competition for capital. I'm allowed to underwrite nearly $500 billion of renewable energy risk because I can attract the capital to do it. The insurance industry actually isn't highly profitable. We don't get many new insurers started up because the return on capital is really low. Sometimes we do make some good returns, but the long-term return on capital is very poor. But the important question is not can we make a profit or not, it's how that capital is used, right? So Emma, you made a really important question about working with the insurance. How would you like to see the insurance industry deploy its capital? And let's move away from the question of should we be allowed to make a profit or not, because if we can't, nothing will happen.
Emma, John?
I mean, this is a whole session on its own, and I can't see you. I don't know. Right, great. It's a whole massive discussion. How do we how do we get that combination of investment in the right way? And I think one massive project that needs this kind of thorough investigation, challenge as to how to invest in the right way is actually here in London, and the Thames Estuary 2100 programme, which is a world-renowned adaptive pathway setting out how London needs to reinvest in a barrier, the hundreds of kilometres of defence systems that protect London, all of its assets, all of its people, and bringing that that discussion around a real-life example that needs to be funded and delivered by very set periods of time, which are actually coming further or nearer into time, as well as the science is telling us, is one way that we can make a real difference and bring together the right combination of investors, agencies, government, businesses to get this right. You've also got 30 odd local authorities across London, and unless every single one of those local authorities works together consistently on this one climate hazard, we won't be protecting London in the way that it needs to be by, I think the first set of risks start kicking in 2035 beyond the barrier, and slightly later this side of the barrier. And I'm not talking about the barrier itself, that needs to be built by 2070 is the current best assessment. So yeah, I mean, I'm not going to come up with a simple answer to this, but there are some very, very big projects that if London is not climate resilient in this country, it could, as the only part of the country that has net positive contribution to the economy, then it could, you know, what it could mean for the UK as a whole doesn't bear thinking about. So we need to get these conversations happening sooner rather than later. Thank you.
Yeah, I'll just make 2 points, if I may. One is, it is important that insurance companies, unless they're mutual, that they make a profit. Because if you don't, your cost of capital goes up, the shareholders pull out, and then suddenly you can't finance it. That is the reality. What worries me is that the insurance sector is being teed up in the sort of political sites, if you like, because it's a great headline, isn't it? An insurance company will not insure me. Well, yeah, that's because you're in the middle of a floodplain and I'm not allowed to charge you the premium I want, and it's linked into the inflation argument. But you know, insurance companies are, I'm sure, politically very able, but that is going to be something they're going to have to deal with. So what's the hope? Because I don't want to sort of end on a negative. The hope is that actually insurance companies are incredibly good and very clever at thinking of financing mechanisms. And there's so many examples of this. And I would even say Flood Re was a clever example, that people are looking around the world at that sort of system. But they've got to sort of avoid being the political scapegoats.
Thank you. We are finishing 45 seconds early. So John, Emma, Jonathan, Alex, and Alex, thank you very much.
Thank you very much to our panel. We have some big news coming in the next session, which was alluded to earlier today. So if you could all make sure that you're back in your seats by 12:20, that would be great. We're going to be starting promptly soon after. But for now, please have a coffee upstairs or on the 3rd floor. Thanks.
Yep, 1, 2, 3, 4, 5. 5, 4, 3, 2, 1. Great.
Hello, everyone. Welcome back. If everyone would like to grab their seats, we're about to start again. I can see the coffee has worked brilliantly and motivated lots of conversation. But we'll begin our next panel now. If I could have a little hush across the room. I feel like I need a glass to tap. So we've got a few more coming in at the back. Great. Thank you, everyone. I think we're all making our way to seats now and coming in. The next session looks at emerging economies. Emerging economies are those that tend to suffer most from climate and economic volatility, but it's also one of the areas where the industry is showing its greatest innovations. And so to talk us through those and how we can unlock opportunities for the industry, please welcome to the stage Emmanuel Balogun, the Associate Director of Africa Practice, and our panel. Thank you.
Hi, everybody. How are we today? We're well, good. All right, I'd like to say first, congratulations to the Conduit for this great event so far. And it's great to be part of an event that's dedicated to the insurance sector. Insurance plays a key role in mitigating challenges that can arise from country risk, political risk, contractual risk, financial risk, increasingly performance and technology risk, decommissioning and end of life of an asset. And effective risk allocation helps unlock capital and increase collaboration. In the African context, it's clear that we know, insurance is key in economies that deal with droughts, cyclones, all these, different kinds of climate events. But what's unfortunate is sometimes we see that insurance doesn't actually pay out. So the role of insurance must not be understated in the developed, emerging, but especially in the frontier market contexts, where I do lots of my work. In this session, I'd like to speak to, just quickly, event risk, where one of our speakers is actually late. So I wonder whether that could be a new form of insurance that we could think about. So in this session, we'll be unpacking insurance in many of its focus areas within the development finance context. I'd like to introduce Noam Unger, Director of Sustainable Development and Resilience at CSIS, the Center for Strategic and International Studies, a leading resource for policymakers confronting a new era of great power, competition, with innovative research, diverse viewpoints, and cutting-edge research on multimedia. That's him. That's where you clap. So it's quite a hybrid, as you can see. Hi, Noam.
Hi. Hi from Washington.
So I'd say good morning to you. We're waiting for Mattia Romani. I'll introduce him anyway. Partner of Systemic. Systemic is a capital market company that identifies and invests in innovation that can drive system change, hence the name Systemic. So I'm going to give the floor to Noam, who can speak to his work in Washington at a time where we've seen a few surprises from the development finance community there.
Well, thank you, Emmanuel, and thank you all for this excellent topic and conference. I'm sorry I can't be there with you in person. Look, to say that it's a massive understatement to say that we're at a tumultuous time, and the new U.S. administration is emanating tumult. And in many ways, it's an infectious tumult. It's not limited to the U.S., but given the U.S. position historically in terms of its contributions to global development finance, global development support, humanitarian support, there's a lot of change afoot. And much of U.S. global development and humanitarian support has been drastically affected by abrupt cuts and dismantling of USAID. And the short story of that is that in many ways, we in the US are throwing way too much baby out with the bathwater or cutting off our nose to spite our face. You can pick your metaphor. I used the latter when I was testifying on these issues in terms of foreign aid effectiveness in front of Congress just 2 weeks ago. But it's also important to recognize that there are antecedents to the current moment that have been brewing for a long time with regard to foreign aid effectiveness. And there's been a growing recognition that we need to tap private sector and market forces much more effectively to achieve the SDGs, to achieve development and humanitarian goals and climate-related goals. And so in the interest of country resilience and developing country resilience in particular for this conversation, we've been needing to develop and have been striving to develop better approaches to working across public and private sector forces. So I mean, we can get into it, Emmanuel, but that's broadly, I think, where we are in teeing up for this conversation.
Thank you so much. So how does the agenda move forward in the context of emerging resilience? Resilience economies.
Yeah, I mean, this concept of an emerging resilience economy is important because the ideas that we can talk about here, it's important to think about, are not actually reactive to the current moment that's sort of driven by change in Washington. And in many ways, they may be quite fit for it. So, you know, we can lament what's happening in many ways in terms of foreign aid cuts and drastic reforms. But there are many ways that we've been, you know, envisioning reform. And in some ways, maybe there's a ray of hope when we think about some of the ways that insurance can play a role. So there's this concept of an emerging resilience economy. You know, as we do not make as much progress against climate mitigation as we all would hope, we are increasingly in the realm of having to pay more and more attention, unfortunately, to issues of climate adaptation and resilience. Those issues are rising on the agenda, especially for vulnerable, hard-hit countries by extreme weather impacts. And there are important investment opportunities associated with that have repercussions for economic stability, for global supply chains. It's not just about costs. We have to think about this as a sort of new and emerging economy. And insurance plays a big role within that. We currently have pressures to react to increasing levels of disasters around the world. And we also have downward pressures on budgets associated with doing so. And I hope that we may finally be at a tipping point where the wisdom of prearranged financing is more broadly recognized and has greater appeal because of its cost effectiveness. And that's not, in the US context, a partisan issue. It can be one forward-looking area that could be constructive. And that could tap the power of insurance and some of the innovations that we could talk about.
So I think we're touching upon the point of parametric insurance there. I wonder if there are any examples that you want to speak to at this point?
Yeah, I mean, we can talk about parametric insurance. With regard to parametric insurance, I wasn't only speaking about parametric insurance, but there are innovations associated with parametric insurance that tap technology, remote sensing, better climate information services to yield more cost-effective, different cost structures that are good for, that are cost-effective for insurance deliverers and the insured. Examples are extreme heat models. There's been experimentation. In fact, this past year was the first payout with regard to heat insurance for a massive cooperative of very poor women working in India through SEWA. Payout for when extreme heat reaches above a critical predetermined threshold, they get a payout for a premium that's associated with roughly 1 day's wages for work that they cannot do so that they can actually better protect their children, better protect their own health. And I think that there are many types of models like that for parametric, for index-based insurance associated with heat, associated with flooding. But there's also other innovations that I was referring to, Emmanuel. And I'll speak from the US context, for example, with regard to the Development Finance Corporation, which is an important element of US global development finance that's not associated quite as much with the current dismantling that's happened. And in fact, the Development Finance Corporation is up for reauthorization later this year. But the Development Finance Corporation, for example, recently, just at the end of this past year, engaged with the government of Ecuador, working with DFC, working with the Inter-American Development Bank, working with the Nature Conservancy and Commercial Bank. They announced a financial close of a debt conversion, right, enabled by $1 billion in political risk insurance, which came from the DFC, the Development Finance Corporation. And this recent debt conversion for conservation generates resources to support implementation, in this case, of the Amazon Biocorridor Program. And it's the first of its kind in the Amazon region. The refinancing deal is expected to generate $460 million. And DFC's political risk insurance has also enabled debt conversions in other places, Belize, also other parts of Ecuador, but Gabon, El Salvador. There are other types of innovation that really could be scaled up, and we could talk about some further, even in the humanitarian context, for example, partnerships with WFP.
Thanks, Noam. So I'd like to introduce Mattia. We've already introduced you, but good to have you here. We spoke about how you're going to pay out to the audience for being late. But yeah, it'd be great to hear more about your work and your focus within this context.
Well, thank you very much, Emmanuel, and I apologize. The only excuse I have for being late, and it's raining, but I suspect in London that's a bit of a lame excuse, so I don't think I'm going to get away with it. Well, thank you very much for having me here. It's a pleasure because, as you know, Systemic is a systems change company. We believe that insurance can be transformative for unlocking private finance for emerging developing countries. That's why we're paying attention to it. We also are aware that insurance is under enormous pressure, and the insurance industry is unlikely to look what it looks like today in 10 years' time. And there's many trends that are disrupting that space. But nonetheless, we think that in a context in which the insurance protection gap in emerging developing countries is over 90%, and given what we know is going to happen in many emerging developing countries because of climate, insurance becomes an absolutely essential element of their resilience and growth planning. And we think that in particular, besides it being essential to amortize the impact of climate in terms of the losses of the assets in emerging developing countries, it's more interesting perhaps to look at how we can enhance and incentivize private sector investment. And that's really the focus that we have. And we think that there are at least 4 good reasons to think, and we have evidence there are 4 good reasons why insurance can really unlock private investment. First, and most obviously, is we know that all countries that have higher insurance tend to attract a lot more private sector investment. Why? Because private sector feels they're more protected. They have tools to de-risk their investments. So that's an obvious one, but the evidence is overwhelming. And the World Bank has done some interesting work on this, showing that this is increasingly the case, as in private sector investors are much more careful about investing in countries where their insurance is accessible now than years ago. So that's becoming more and more true. The second thing is that we have plenty of evidence that the credit worthiness of countries can benefit significantly from insurance, and there's plenty of examples. The most recent one is the debt for nature swap in Gabon, with sort of a credit enhancement thanks to political risk insurance, brought those bonds to investable grade when and well above the sovereign investing grade. So, and we have plenty of examples of this. I used to be at the European Bank for Reconstruction and Development, and EBRD did a number of deals, most famously the hospitals in Turkey deal that enhances, thanks to political risk insurance and some other elements of insurance, particularly on cash payments, enhances the credit worthiness of the investment well above the sovereign. So that's a second way. A third way, which I think is quite interesting, is how insurance can work with MDBs. So we are in the middle of a big debate on how to make more of existing capital of MDBs. I suspect this debate will become even more fierce in the coming months as capital increases will become difficult given the political crosswinds. And so we have to find all possible ways of enhancing the value, the capital, the potential of the capital of NDBs, and insurance can do just that. I think the most striking example is the work that the Inter-American Development Bank is doing on risk transfer for their balance sheet. So they've managed to risk transfer about $300 million of their exposure on the balance sheet, which means that those $300 million on their balance sheet can be used with the leverage of the Inter-American Development Bank to invest in emerging developing countries. So the insurance here plays not at the project level, but at the portfolio level of the MDBs, which I think is a very interesting model that I'm sure we're going to see replicated together with some other interesting models for increasing the power of MDBs to deploy their capital. And fourth and last, if you turn it around, what we are discovering is that blended finance works really well with insurance. And why? Because if you use concessional capital, for example, as it happened with extreme heat income insurance in India recently, if you use it to subsidize the premium for customers, actually the mobilization that you achieve, the leverage you achieve with your concessional capital is extremely, extremely high. So blended finance players are looking more and more at using blended finance not as traditionally done, which is to reduce the cost of capital for investments, but by acting on insurance premium. And this de-risks at a much larger scale and allows for a much better return, if you want, on investments on your blended finance dollar. And if you think about these 4 examples I just gave, I think linking a little bit to what Noah was saying, all of these are actually quite resilient to the political crosswinds that are blowing through the space in the spirit. They offer commercial opportunities for insurance companies. They're about leveraging existing capital better, and they're about making getting more money for your buck when you invest a concessional dollar of money. So I think the space can navigate this period particularly effectively. Let me stop here.
Thank you. No, I appreciate all those examples that you just shared. I wonder whether you could just touch upon the 10 super levers that Systemic has, I guess, shared to catalyze finance in climate vulnerable countries.
Yeah, with pleasure. So the work of Systemic on leveraging private finance goes back to a few years ago. We've been working very closely with the independent high-level expert group. This is Nick Stern, Vera Songwe, and Mahat Bhattacharya's group on the climate finance framework. And more recently, we've been working closely supporting the great work of the Bridgetown Initiative. And you know, these two pieces of work have really shaped a little bit, we believe, thanks to the fantastic work of the Prime Minister of Barbados, of course, and the great work of the chairs of the Independent High-Level Expert Group. They really shaped this debate. And so these 10 levers, which really, and I think the paper has been circulated, you can find it on our website, lay out a little bit what are the most effective way at this point to ensure that in a moment in which we are going to need more private finance, that can be unlocked. And it looks at it both from the perspective of what governments and international organizations can do. So it looks at various elements of NDB reform, for example. It looks at what insurance can do, but also, and I think that's what makes it quite interesting, it looks at what the private sector can do differently. So, for example, one thing that I want to highlight of that, which I feel particularly strongly about, is data sharing. And this is incredibly important because one of the big obstacles, as we know, in investing in emerging developing countries is the gap between perceived risk and realized risk. I'm sure there's some friends, I'm not going to name the company, but we work closely with an investment fund that invests in Africa, and they were telling me that on their renewable investment in Senegal, the realized risk of those investments is lower than the realized risk of the same type of investments in the United States. So the project level risk of many of the renewables projects in particular are extremely low, but the perceived risk is very high. And how do you reduce and squeeze that gap? By making that information, the one I just gave you, much more easily accessible to investors, so they know exactly what risk they face. And still, this information is not easily available because there's not enough investments, and because the companies that make those investments still keep that information confidential. So there's a lot that the private sector can do, I think, in this particular area. There's other levels. I don't take you through all of them, but please take a look at the paper. I think it's quite an interesting.
Thank you so much for that. I think I'm actually most interested in the lever that focuses on expanding local currency. But I won't go into that. I'll let Noam come in unless he has any comments on what was just said by Mattia.
Well, thank you. I actually, I want to take a moment to praise that power levers, or I'm going to get the title wrong, report by Systemic, because another one that is not the one that you're focusing on, Emmanuel, but is on bolstering sovereign insurance in particular. And by increasing affordability, by incentivizing greater penetration and greater investor confidence, which was something that Mattia was speaking to. And he was also talking about the increased opportunities and value of blended finance. I started my career, I come at these issues as not an insurance expert. I come at these issues as a U.S. foreign policy and global development and aid effectiveness person. But I started my career working on humanitarian crises and humanitarian issues. And some fundamentally humanitarian organizations have tried to move quite a bit over time to embrace it and begin to better integrate prearranged financing, including insurance. And the World Food Program is an example of that. And it connects to this topic of sovereign insurance because, for a number of years, actually, the World Food Program has been scaling up one program that was initially developed by Oxfam in connection with Swiss Re, but it's not just Swiss Re, it's Howden, it's Zurich, it's AXA, it's so many organizations, many of whom are involved in the Insurance Development Forum that have been experimenting quite a bit with these issues over the last 10 to 15 years. But WFP has taken some of these issues and scaled them up. They've also done things like helping governments buy additional coverage for their sovereign insurance policies by essentially adding to the potential premium. And essentially WFP puts a few $100,000 towards countries' efforts to get greater coverage through higher premiums, which actually adds millions of dollars in coverage. And when disasters do strike, some of those payouts are then put back towards WFP programs in ways that prove impressively cost effective. So Hurricane Julia hit Nicaragua in 2022, triggering the tropical cyclone policy that the government had put in place with the Caribbean Catastrophe Risk Insurance Facility. And a very helpful portion of that payout went back toward the costs of WFP programming in Nicaragua, where 60% of the population was affected. So I think it's also important to look at these mechanisms that have been developed over the last 10 to 15 years, especially multi-country risk pools that have been developed, like CRIF that I just mentioned, but also the African Risk Capacity, and see how we might be at a tipping point where we can actually do more on the preventive side, on the prearranged side, by arming greater, smarter, market-oriented and private sector-oriented support to some of these sort of macro and meso tools that have been developing.
Thank you. So what do the next 10 years look like for insurance in the development context?
Well, I think there'll be 2 or 3 really big opportunities in my view. The first one will be understanding how to crack the emerging markets. And this is a commercial opportunity, I think, for insurance companies. And it's not an easy one. There's issues of affordability. So in some instances, blended finance and working with NDBs will be the way to do it. And you know, I quite like the idea of insurance companies starting by taking the risk off the book of an IDB or an IFC or an EBRD, because it gives them a little bit of understanding, and they start working on understanding sort of the more aggregate risk. And I mean, there's plenty of insurance companies that do fantastic work already in emerging developing countries. So I'm not saying that none of them understand the space. Of course, there's different degrees. But I think there'll be a really large opportunity there. That's the first one. The second one, from my perspective, is how I think what we're going to see over the next 10 years, a really much stronger incentives for insurance companies to use their asset side to invest in adaptation and resilience. But in order to do that, we will need to crack the issue that is really a network market failure, to use the economists' language. And by this I mean that the benefits of investing for an insurance company to use their assets to invest in adaptation and resilience, the benefits of that means lower losses for everyone, not just for themselves. So how do you capture those benefits or share those benefits in a way which create incentives for everybody to put some money to adaptation and resilience up front? That needs to be cracked. And it's very important to do it because, of course, it's in everybody's interest to do that. It means lower premia, it means lower losses, and it means, of course, much more resilient economies. And I think the third area that I think will be very important is how the regulators will look at this space. Because so far the regulators have been looking at the insurance industry without really having in mind the longer term potential that insurance has to create resilience, growing economies. And so the regulators have been, of course, acting on the back of ensuring that the risks that the insurance companies are taking are manageable and the insurance companies is solvent as a whole. And that's been the primary objective. But I think in the next 10 years, we'll need to see regulators thinking more about how do we unlock the power of insurance industry without compromising on their ability to remain solvent and manage risk properly, but understanding that the value that they can bring to the economy in this moment is extremely large. So I think these are the 3 things that I think, in my view, we'll see changes substantially in the next decade.
Thank you. Thank you very much. Noam, do you have any comments there? Sorry, we can't hear Noam.
Oh, I'm sorry, say that again?
So we can hear you now. Just wondered if you had any comments in terms of next steps for the industry.
Just I agree on the point about the investment side. You know, the insurance industry broadly controls the second biggest pool of investable capital globally after pension funds. And so unlocking that for progress against our shared societal challenges is incredibly important. Also, you know, the other point that Mattia was making about pressures and changes on the insurance industry are exactly right. And in fact, the insurance industry faces different pressures. You know, sitting in Washington, discussing insurance, people's minds often turn to the challenges of insurance in the United States, where insurance is regulated state by state. In some cases, until recently, there have been very short-term perspectives that don't even allow insurance companies to use predictive modeling in setting their pricing. It leads to many different distortions. And there are a lot of questions about what is insurable in a US context with really high damage costs. At the same time, in vulnerable countries around the world, there are massive challenges of a protection gap and of low penetration. And we need to build up the robustness of insurance systems across those markets. And in many ways, that's maybe the place where insurance companies are perhaps innovating most is also these emerging markets, which help them diversify and can help them continue to grow and remain solvent. And so I think there are these challenges that are happening over time, and at the same time, the innovations around parametric index-based insurance are only going to grow, and we have to find ways to scale and take the best lessons from those and scale those up.
Thank you very much. I'm afraid we have to actually wrap up and end there, but I wonder, are there any questions before we close? There's one at the back. Yes, please.
Hi, morning. Thank you. Fascinating discussion. One of the challenges that I'm facing, at Zulu Ecosystems, where we're in the business of putting in place nature restoration programs to provide a lot of the benefits we're talking about here over the long term. One of the challenges we face is actually around quantifying the future, the avoided premiums in future as a vector, if you like, for quantifying the benefit of these programs. And this is the sort of language that corporates understand, which they can then invest behind today because they can see that in future they might actually make some savings. This is a sort of, I'm just throwing it up as an example of something that perhaps the insurance industry can do, even in a world where there are public benefits, but in a sense it's as an enabler and as a catalyst. I just wonder whether that's already happening and whether there are these sort of forward pricing curves that we can start tapping into.
Is that something that you want to take, Noam or Mattia?
Mattia, go ahead.
So the first answer is I don't know if there are forward curves that the insurance industry is using. I would be very surprised if they haven't. I suspect some people in the room will know if they are currently using projections on that. But I mean, we go back. It's a very good point. We go back to the problem we talked about earlier, which is I think it will be very hard for. So there's two types of investments for adaptation and resilience. There are investments where the benefits of investment are captured by a single agent. And then it's easy, right? Because if you do the investment, you're the only one that is going to capture the benefits of that investment. Then you can make a fairly good calculation of whether the reduction in premia you can expect are going to pay off for that additional expense. So for example, if you are a household and you say, okay, do I want to put some flood protection to my basement? You're likely to be the only one that will benefit from that flood protection if a flood occurs. And so you can make a calculation, well, if I do it, I talk to my insurance reduces my premium, you can make the calculation, it works. But the greatest majority of the very important resilience and adaptation investments are not of that kind. They're of the kind in which you put the infrastructure in place and the benefits are shared among many agents. And then the calculation becomes very difficult because it is the sum of the reduction of the premia that matters, but the benefits for that are diffused to all of those agents. So how do you coordinate that? It's a classic market failure. So I suspect it's going to be, and that's what I was pointing to earlier. I think that's really what we need to crack in the next decade from a regulatory perspective.
Thank you so much, Mattia. Noam, appreciate your expert insights. I'm afraid we have to wrap up there, but do keep the conversation going with the speakers directly.
Thank you.
Thank you very much. We have a very swift set change, but we had a slight teaser to the conversation that's coming up in our session earlier on good growth. We have a very specific insurance-led solution that could potentially have huge benefits. So leading our panel on flooding, please welcome to the stage Paul van Zijl.
And I think I'd like to bring up the panelists as well, so if you all come up as well right away. So we hinted a little bit earlier that we were going to make this a do event, not just a talk event. And so in advance of this panel, we'd like to make what I think is a really, really exciting announcement. So today we are delighted to announce the launch of Reflood, a coalition of companies, organizations, landowners, and individuals committed to expanding the use of natural flood management as a way to protect communities and the environment. Reflood will seek to use innovative finance to significantly expand the use of wetlands and other forms of natural flood management to protect homes, assets, and infrastructure from the known risks of flooding, while seeking to maximize multiple environmental co-benefits such as carbon sequestration, biodiversity gain, and water quality management. The initial members of Reflood include Howden, Zurich, Flood Re, the Crown Estate, the National Trust, National Highways, Barclays, Nattergal, and Planetary X. We're also in dialogue with the Environment Agency, which plays a vital role as an investor in the nation's anti-flood defenses. Reflood is part of the Conduit's solutions agenda, a recently announced set of initiatives convened by the Conduit, which is intended to accelerate some of the world's most pressing problems. Solutions to some of the world's most pressing problems. Other solutions agenda initiatives include a major conference on the first day of London Climate Action Week on the relationship between public health and the climate crisis in partnership with the Wellcome Trust, the Green Economy Forum, the third in a series of major convenings the Conduit has held every November aimed at supporting and accelerating a just transition in the United Kingdom, and Resilient Cities, a convening in partnership with the Resilient Cities network of mayors and chief resilience officers from over 40 cities across the globe, designed to allow them to share best practices and cross-sell solutions offered by for-profit companies and not-for-profit organizations in each of their cities that help produce resilience in the spheres of public health, the environment, the economy, and good governance. We launched the solutions agenda because of a conviction that the world's greatest challenges are better understood as solutions waiting to happen. We want to use the Conduit's convening power to catalyze and accelerate action. And we're confident that Reflood will quickly demonstrate the power of its members to transform the catastrophic risks of flooding into a force that protects communities, houses, and infrastructure, while demonstrating that natural flood management can create a natural asset class with climate co-benefits and significant revenue streams. And I'm therefore delighted to welcome onto stage a remarkable group of people drawn from the founding members of Reflood to discuss how we're going to make that happen. And the first is Harry from the National Trust. And I'm going to give the National Trust a big shout out here because I think over a year ago, we held an event at the Conduit as part of our partnership with the National Trust, in which Harry, and again, I'll call out Claudine and Aviva, give a big shout out to them, spoke about this work that they were doing in the reestablishment of wetlands. And that set about the germ of the idea that has led to this coalition. So, Harry, tell us more about your work in that regard.
Thank you, Paul, and great to be here. So I thought what I'd do, Paul, if that's okay, is just a tiny bit about why we're interested in this agenda, and then I'm going to give a bit of nature sparkle beyond my shirt, if that's all right, and show you some images of 3 examples that the Trust is involved with, either directly or indirectly, that might bring this work to life. So we were formed a long time ago, in part to protect nature for the people of this country. And 130 years have rolled by, and I would say, rather depressingly, we've slightly failed in that task. And my boss isn't listening, I'm hoping. And a large part of that is about fresh waters. So if you look at the state of nature in the UK, which is in real peril, we're one of the most nature-depleted countries in the world. As a subset of that, our fresh waters are in real peril. And what I mean by that is our rivers and our lakes and our ponds, etc. And just to bring that to life with one specific stat, there are no rivers in England in what's known as good ecological health. So, having failed in that work, we're beginning to think, well, what is a system-wide sectoral approach to the stuff that we're bothered about, which is nature and the benefits that accrue from that for the nation, and we're particularly thinking about that in a river and watery environment. So, can you bring up my slides, please? And I'll just canter through 3 examples. Are they behind us? Yeah. So the first of these in the Lake District. This is a river, euphemistically in this slide called a river, acting as a drain called the Goldrill Beck, which was improved for agricultural purposes 100 so years ago, and it's basically a channel for water to disperse downstream. Now, in 2016, those with a long memory remember the Storm Desmond impact, where it had pretty catastrophic impacts on people and communities in Cumbria. And that was a real catalyst in this place to take this river and reconnect it with its floodplain. You can see how it's acting right by the road there as a drain. This is now what it looks like after reconnecting it with its floodplain. So that's brilliant for nature. We've got a lot more wetland habitat created there, but actually really interestingly in terms of this is the flood response downstream. And what this graph shows is how long it takes floodwater to disperse now from the floodplain, and the height of the flood is much lower downstream now as a result of this work. The next one, and in some ways these become progressively more interesting, I think. This is Honeycutt in Somerset, where we've taken a practice from Oregon in the States called Stage 0 river restoration, where we've basically allowed a river to reimagine itself as it would have been post-glaciation. And what effectively that's meant is filling the river in, much more technical than that, but basically filling the river in and allowing it to re-find its channel. And you can see that is brilliant. You can imagine that is brilliant for nature. You go there in the summer and it is absolutely hooching with the sounds of insects and birds. And this is the sort of impact that it's had. It's taken what was a drainage channel and turned it into an extraordinary wetland, which is now attracting things like white-tailed eagles. So that's brilliant from a nature perspective, but again, working with the University of Exeter, this is a year on from that work. It's having a really significant impact on downstream flooding and other things like turbidity in the water. So this is only a year old, and so far on the last big flood event, we saw a 36% reduction in the height of the flood emerging from that land. And then the third, and this is really close to home for me, I live in Sheffield, so this is the grey to green intervention in Sheffield, which is taking the city a bit by storm. So Sheffield really impacted by floods, particularly in 2007, 2 deaths, millions of pounds worth of property damage, in part driven by lack of surface porosity, i.e. water just flowing off roads. So this is a reimagining about what natural flood management might look like in a city. It's having really good impacts on flooding. It's also cheaper than conventional over a 10-year frame, and it's also being, interestingly, really effective at reducing pollutants. It's also, and this really matters to me as a citizen of the city, it's just a really beautiful place that is great to hang out. So this was a dual carriageway a few years ago and is now a linear park in the city. So I'm going to stop there and hand on.
So you can imagine when you hear these sort of anecdotes of what the National Trust has been able to do, it's crying out for scaling. The power of these wetlands to have climate co-benefits, to have all these biophilic benefits for people in cities, and to avoid flooding in ways that are remarkable at a lower price per investment, says there's something magical about these. Which brings me on to the Crown Estate. The Conduit has for a couple of years now worked with the Crown Estate, and we were incredibly lucky to be introduced to Caroline, who has, as you're about to see, deep expertise in this precise subject matter. And what we've been seeking to do is stitch together the largest and aggregate landowner in the country in the form of the National Trust, the Crown Estate, which is right up there, but also acts for the public benefit, to put these together into this coalition. And so, Caroline, I'd like to ask, why is this of interest to you? Why is the Crown Estate on the stage, and why is this something that you think you have a contribution to make on?
Thanks, Paul, and hi everyone. Lovely to see you and really pleased to be part of this super important conversation. So the Crown Estate is interested in being a part of this conversation for a few reasons, and I'll try and explain them briefly. Firstly, as you've highlighted, we, like the National Trust, are a landowner, and we have a whole series of assets that we look after that's, rural agricultural land, Windsor Great Park, and then we also have a really important role looking after the land that we manage on the foreshore as well. So we have a really interesting set of interests, if you like, that sits across the system that Harry spoke about, starting right up at the top of the catchment, taking us all the way down through and into the coastal hinterlands, estuaries and beyond. So the concept of flooding and natural flood management links those things together so perfectly. And if you take that together with the ambition that we have around restoring and recovering nature, which is another really important part of our role, and we work with myriad partners on this, many of whom are in the room, the co-benefits when you start looking at how do you address the challenge of flooding for communities and people that work and live in and around the land, and the benefits that thinking about that in a habitat lens or through a biodiversity lens, if you will, that then links us through to in terms of delivering some really exciting outcomes for nature. Those things come together perfectly in this conversation, and that's why it's really important. I think the other thing that I probably should mention in this as well, and it's true for all landowners, I would suggest, which is that when we think about what's happening with our changing climate, and particularly with sea level rises and the increasing risks that we're seeing, not just at the coast, but in the riparian environment as well, it's no doubt that the nature of the assets that sit at that forefront is going to change in the coming decades. And we need to understand what that looks like. We need to understand how we can adapt and change the way that we manage and interact with that land in a way that is sustainable. And that's everything from, if you're looking at agricultural land, for example, in the Humber, where sea level rise is going to lead to saline intrusion, which is going to change the way that you can farm that land. But it also means it's going to change the way that that really critical habitat for wading birds is going to contribute to that area. And I think also then if you think about introducing improved sinuosity through rivers in things like the Windsor Great Park, it's a completely different challenge that interacts with communities in a totally different way, but all comes under that umbrella of how do we manage these really important and valuable assets so that it can continue to deliver value for everybody who wants to use them.
So before we come on to Jonathan and to Flood Re, I'll just add another part of this important initiative is National Highways. And National Highways has a partnership and is supportive of the National Trust. And one of the facts that I was astonished by in conversations with colleagues at the National Highways is that 90+% of the roads in the United Kingdom are built on an engineering standard that sort of predates the advent of extreme weather events like flooding. So this critical infrastructure is also critically vulnerable. And the UK's finances are simply not in a position to be able to upgrade all of these roads all at the same time. So natural flood management is going to become an absolutely essential part of how we address this risk to critical infrastructure. And National Highways is part of a coalition of other big infrastructure players, including HS2, including Heathrow, who are equally vulnerable. So now it turns to the question of, we have landowners who are ready and willing for a whole bunch of obvious reasons. How do you go about thinking about financing the rollout of these wetlands? And how might you do so in a way that doesn't subject us to this tyranny of small, isolated, subscale interventions? How would you do this so that you could build out 1,000 wetlands and create a whole bulwark of these anti-flood defenses? And so for that, we're going to speak to Flood Re in the form of Jonathan.
Hi. And so several of the speakers earlier mentioned Flood Re, so that makes my job a bit easier because a lot of what we do is actually much more in the home space, in the physical risk space. People talked about Build Back Better, but it's worth saying we are a partnership between government and insurers. We're paid for by insurers, but government sets the rules. And despite that focus on physical risk measures for homes, I get to spend a bit of my time on nature because we see NFM as an underutilized tool in the risk reduction toolkit. And let's see. Yeah, great. So my background is in climate and energy. And 15, 20 years ago, conversations in the renewable space would have been a lot like the one today, saying, how do we get big investment? How do we get pension funds? How do we get institutional assets into renewables? And so what did that business model look like? Well, it looked more, this is a mock-up of it, which is like stacked revenue streams in a few small variable areas with government guaranteed revenue streams. So the feed-in tariff, contract for difference, basically a government paid revenue stream that makes up for all the externalities and also makes it an investable proposition by de-risking it. So that's what most of these look like, and as Rebecca said this morning, you know, there's a $100 billion commitment from insurers to invest over the next 10 years in assets, which include this. So this is an asset class, this is how it got there. What could this look like for nature? Pretty similar. So all of these revenue streams exist, so carbon credits, water quality, et cetera. And those are small variable revenue streams. It's debatable whether food would be on this balance sheet or on another balance sheet, but it's part of the ecosystem. And then at the bottom, you'd have an NFM payment. So we view that as primarily a government responsibility. So when Flood Re was created, there was also, as the Environment Agency said earlier, a commitment for government to pay for flood defenses, because for Flood Re to stop existing, we stop existing in 2039. The risks have to come down. To do that, there needs to be investment in flood measures. So that NFM payment essentially could do what a contract for difference or a feed-in tariff does. It makes it an investable proposition. Why would government do this? Well, right now, if they do NFM, they pay 100% of the cost. Not quite, but effectively they're the, you know, when you build a dam, government built it in its entirety, small amount of contribution. This crowds in a lot of other investment. So it means they're not paying the majority. It does shift it from capital spending over to operational or funding, but ultimately it crowds in all those other investors or other payment streams. So can this be done? Yes. There's a project called the Wire Valley NFM project, which was led by the Rivers Trust, and we were one of the partners. This is a multi-partner, multi-benefit revenue stream model, and it is exactly that. You know, there were investors in that. We were a research partner, essentially to prove that this, you know, proof of concept that this works. Proof of concept that the business model works, which it does, and then proof of concept that that the interventions work. And I kind of like the distinction between this really complicated financial business model and the fact that this is like sticks in a river. But that's what we're talking about, and actually it does. It slows the flow of water. It doesn't replace what engineered defenses do, but it does what it does really well at really low cost. So the ultimate proposition for this is that it should be a government responsibility. Part of that agreement is insurance premium tax provides about 10 billion per year, and notionally some of that is earmarked for risk reduction. The Environment Agency spends about 800 million on flood defenses a year. Over the last 10 years on NFM, I think it's spent about 40 to 50 million. So that's basically half of 1%. And if it were its own documents, they have something called the long-term investment strategies, which lays out what they should be investing in over the next 5 years. That says 5 to 7% could be from NFM. So that would represent a 10-fold scaling up of their investment. Crowding in all that additional funding, you're talking 20, 25% increase in the skies. That's how you scale it. But it does require government getting into it. The minister, the floods minister has said this is a priority for them. So, you know, it's coming. Oh, and it's worth saying, I have a similar graph showing that, yes, it did work. The goal was 10% reduction in peak flows, but actually it was more like 25%. So this stuff works really well. We can get on with doing it, and hopefully it looks something a little bit like this. That's it.
So to kind of recap and then tee up Nick Stace from Barclays, you have an asset that is cost effective, has climate co-benefits, assists with flood reduction, and is drastically underfinanced from a public finance point of view. Less than 0.5% of EA money goes to this, but you have a multi-billion pound expenditure in aggregate across the United Kingdom in anti-flood defenses. If you take the EA and national highways alone, you're well into $1 billion plus of expenditure. And then you have all these aggregated other pockets of capital. And the one thing that is dramatically underspent on is NFM. So Nick, you head sustainability at Barclays. Why would you be interested in this particular topic?
Well, firstly, Paul, thank you for inviting us and all the sponsors as well. I think this is a really good example of the Conduit really at its best, bringing an extraordinary group of people together, identifying a major problem in the world, coming up with solutions, and then collaborating around how we might work together on that. So thank you for doing this. The second thing I'd say is that this morning I think it's been incredible. I mean, I've learned an immense amount. And one thing I've also learned is who knew that insurance was cool? And it really does feel that way. It feels like the insurance industry, the banking sector, but also all of us in this room who are not necessarily part of that can be part of these extraordinary solutions. So Barclays, and why would we play our part, or the banking sector more generally? Because I think the important thing is here, I'm not really here just to represent Barclays. I think there is room for all banks to play a part here, so this shouldn't be just exclusive to us. There are a few things. I mean, firstly, we all agree, I think, that there's a problem that needs solving. I mean, the problem was outlined brilliantly earlier by Barnaby, where he talked about the fact that there are 6 million properties at risk of flooding at the moment in the UK. That will rise by the mid-century to 8 million. And for us, just looking at it from a parochial point of view, we have 20 million customers, most of whom have homes. We've got 1.2 million small businesses, all at risk, potentially directly or indirectly from flooding. We've got 38,000 farmers that bank with us that also have risks themselves, but also can be part of the solution. So we feel like we've got a massive stake in helping to make this work. We've also got increasing risk. Whenever I attend the monthly risk meetings at Barclays, floods comes up as pretty high up the risk register. So we've got something that we really need to tackle ourselves. So secondly, and this is really over the last few months, and I used to work with Harry. I was on the board of the National Trust for a number of years, completely separate to my work at Barclays, but have seen the work that the National Trust have done over that time. And I've personally, therefore, seen some of the interventions that have begun to work. And I think we feel at Barclays that this could be a game changer. Now, it doesn't mean that the other defence sort of grey infrastructure, I think it's called, where you create dams and drainage and so on, aren't important. They are, but they're expensive, and in many cases they are being overwhelmed by the floods that we're having and that we will have in the future. And so we see this as a great complement to those other defence mechanisms and something that can be scaled. And the sort of scale I think that the Conduit's speaking about here is anywhere between 500 and 1,000 sites across the UK, which gives you a sense of kind of the impact that this might have. So the second thing is we really feel this has a game-changing dimension to it. And I think, Paul, in the conversations we've had with 40-plus organisations now, I mean, that is, that many of them agree with us. The third thing is that we think at Barclays and other banks, as I say, for that matter, can help to scale those benefits. And those benefits are everything from the nature markets that have just been explained just a few moments ago. So the nature credits, carbon credits, biodiversity credits, clean water credits, carbon capture. There's an immense amount there that if we can capture that and monetize that, then that can also feed into the system to help create more wetlands as well. And we've got evidence in other parts of the world where this has worked and is working. So in our team at Barclays is someone who's spent the last decade working in the Netherlands, where, I mean, interestingly, and a very interesting statistic, in the Netherlands, people, of course, you might imagine, worry about flooding. Actually, they worry about it at the lowest levels in Europe. 6% of the public are worried about flooding in the Netherlands, partly because they've got a real handle on it. The place that worries about flooding most of all is Spain across Europe, at over 50%. So you've got a sense that it is possible if you collaborate with others, work with others, and come up with these kind of solutions to meet the challenge that's set, but also satisfy public concern as well. So we want to sort of lean into this. I would say it's not going to be without its challenge. I think we've all outlined sort of how possible it is, but I think we should say there's an awful lot we probably don't know at this stage. And the next few months, and we've set aside, I think, for the rest of the year with this steering committee, we'll be working very seriously to understand how it can happen and why it hasn't happened before, and to try and overcome some of the complexities that exist.
So thank you very much. And I wanted to underscore a point you made. The whole idea of this convening is to make it open source and accessible to everybody. This is the initial group of co-conspirators who are launching this, but banks, landowners, insurance companies, data companies, project engineers, people in the measurement space are all very welcome. And as part of what we want to do today and why we're excited to announce it is to invite this really remarkable audience that we've assembled. If you're interested, come and speak to us, because there will be several work streams that we will set up around this to try and bring this to scale. And this is going to require a collaborative effort. So let's go back to where we started, because one of the things that Harry mentioned to me in one of our sidebar conversations was that their insurance claims for flooding and subsidence on national trust properties had been going through the roof because of flooding. And the irony of all ironies is the National Trust was also solving this, but having to deal with this as a real issue on its properties. So for the largest landowner to be an enthusiast around this, one of the things that we would seek to do is to try and both help you finance the building of these wetlands, cut through some of the kind of regulatory challenges, because I think you have said that some of the wetlands that you've been involved in, they cost twice as much as they should have, because there were a whole bunch of Byzantine regulations which made it inexpensive and inefficient to do so. But also try create a revenue stream from those wetlands to support the work of the National Trust, but to support the maintenance of those wetlands as well on your properties. So you wouldn't have to fund more to maintain them, but it would also create some revenue to support the remarkable work you have to keep land inalienable for future generations. Does that capture the sort of ways in which we would be good custodians to you, Harry, and serve some of your needs and meet some of your needs?
So there's a really short answer to that, which is yes, yes, please, Paul. So I'll just pick up one of those, actually, because I think there's a moment in time that everyone in the audience can bend their minds to. It's the whole regulatory set of arrangements. So we have systematised, particularly in our upper catchments, we've systematised through all sorts of regulation and a drive, quite rightly, for agricultural production over the last 70 years, an idea that we need to get water into rivers and downstream as fast as possible. And of course, in a changing climate, we're realising that there's perversity and a lack of join-up around that. So we've got a moment in time, the government are out to consultation about a land use framework. And I'm really interested in the thought of, well, how about in some places, in some situations where it's sensible to do so, actually we reverse that thought, particularly in upper catchments. So, I mean, what we do know, Paul, is that we need the triangulation that you and I have talked about a lot between the whole of civic society in order to make this work. And Jonathan's analysis of the money suggests that we need both public money, we need private money, and we need the skills and enthusiasm and capabilities in the third sector as well. So, short answer is yes, but it's complicated.
Caroline, one of the things in our discussions that came up early on is that the Crown Estate has also made a net zero commitment on your rural properties. And you're also owner of the seabed and a massive facilitator of offshore wind. But you also are potentially a buyer of carbon credits. And so you're both a landowner, but you're also potentially a source of financing internally and externally for this. Do you want to talk a little bit about that?
Yeah, sure. And I think it's a really interesting spot to be in, actually, because you kind of, sometimes in these conversations, you sort of end up dividing the debate between sort of demand and supply, providers and buyers. And actually, it's really interesting to sort of straddle that space, if that's the right word, and understand it from both sides. Because I think you're absolutely right. As an organisation, like many, we've committed to the decarbonisation trajectory, and with the portfolio and particularly the supply chain that we engage with, that's a big challenge, right? That's extensive. And I think whilst we're very fortunate to have the opportunity, particularly if we accelerate and scale up habitat creation restoration, which gives us some nature-based solutions to that, we're still in the space where we need to think about how are we going to make that really happen in the timescale and the kind of targets that we set for ourselves. So we're really working with a really diverse range of partners who are potential providers, and also understanding the barriers to accessing them. Why doesn't that investable proposition work? Why doesn't it work from the side if you're the provider, if you're creating the habitat, if you're building the wetland, if you're spending the money that that Harry's organisation has been spending? What does that world look like? And then how does that dock in to the buyer side? Because I think that's the other challenge, isn't it? And we often talk about having parity of language so that you can realise these opportunities and get people to recognise that investment solution that they're looking for, it is actually this incredible natural flood management project that's happening. It's just perhaps the language that you use to describe the demand that you need and the supply that can meet it isn't yet the same. So I think that's a really exciting space. And as an organisation that spends time in both camps, if you will, we really see the opportunity for ourselves, but we're not alone in this, but for ourselves certainly to help bridge that gap in understanding and help drive scale in that way.
So the one group that we've this is a conference about insurance and kind of insurers off the hook here in two ways. So I'm going to press you a little bit if you don't mind. The Flood Re is sitting on about just short of $1 billion in assets, and I know you've been very imaginative on how you might through scale up some of the test cases you've done and said there could be a case to try and liberate a little bit of that to be an NFM. But also there's a role of the insurance industry as a whole, which if we were to build out these 1,000 wetlands would be beneficiaries of what would, at least in the initial instance, be state spending, because you could get the EA and National Highways to reallocate more to NFM, and there would be less flooding and insurers would benefit. So how do you get the industry to be engaged and to liberate finance for this in a way that really scales this and also saves money for the taxpayer?
Sure. So there's two parts to that two-part question, I guess. And on the scheme and its assets, so those are there for the running of the scheme, and floodry is seen as one of the ones that's holding up. So you see California not holding up. You see the states, you know, having difficulty maintaining insurability. So that is coming under pressure everywhere, and we are holding up, but it's a different world than we were in, say, 2 years ago. That being said, there's a proposal as part of our, you know, we ask the government every so often to change the rules. There's a proposal to do what Pool Re has done. Pool Re is the terrorism reinsurance. Take 1% of its asset base and apply it to essentially innovation. So, you know, innovation could mean a lot of things, but this is very innovative, so this is one potential application. That's in the government's hands. In terms of what the insurance industry can do, so a lot of what we hear is about resilience in the future is that it's going to be digital and natural. So we've obviously got the nature part, but digitizing that is actually where this comes in, is having the demonstration that this stuff works, that it reduces risk. So usually they say there's been a thing of not having data. Well, 2 of us have data points up on that screen. Those are probably like the only 2 out there. And so we're building out that demonstration so that this can be factored into flood models, which is what is used in pricing. But so here's where the tough part comes in, or the part that no one ever wants to hear, which is that actually insurers don't benefit. So the risk comes down, it gets factored into the flood models, and people's prices are contained. So the beneficiaries are the homeowners, the businesses, et cetera, which is why it ends up being a public investment, which is why the public steps in, because as many people said, it's tough to identify an individual beneficiary, it's much more collective. So the point is getting into the models, which contains premiums, and then that creates the incentive to implement these things from the public perspective, but the insurers themselves are much more interested at the investment stage, so that those huge pools of capital, of which we have one, but ours is heavily limited, but the investment delivery forum, which Rebecca spoke about before, being an example. So that's why it has to get to a safe asset that the PRA approves of, Prudential Regulation Associate, I forget. Yeah. Authority, exactly. And then it can be invested. Yeah.
Nick, I'm going to give you the final word. And this is really around, I think what this has illustrated is we're at the early stage of thinking through all the different ways to do this. And from a finance model, from a land use model, from a data model, from a beneficiary model, we're going to work this out. One of the things you at Barclays have been thinking about is how you might create interesting financial instruments which can take the climate co-benefit revenue streams and monetize them in some way, impact bonds, flood bonds, and other products. Early stages, but give us a glimpse of what you think that could look like in a year or 2 if we did all our homework well.
So I should start by saying I'm not the expert on bonds or the credit markets, but we do have experts who are working on this now. We've got 10 people who are working on this as we speak, some of which taking from, as I mentioned, expertise from other parts of the world where this is seen to work. We're working very closely with the Environment Bank, where we've already started to match up our 38,000 farmers with home builders. So to get the biodiversity net gain benefits flowing through to our farming community as well. So we are active in this space already. And I think, you know, it's nascent, but it's very doable. And I think the reason why we are committed to this next 9 months and really rolling up our sleeves and getting stuck in is that I think the critical part of this is getting the financing piece right. Because in a way, the dependencies for, I mean, with 1 or 2 exceptions, but with most of the dependencies so far has been around philanthropic giving in this space, which has got us so far. But what it doesn't do is it doesn't deliver a scale. And I think the ambition that actually Barnaby spoke about earlier, which is, I'm almost going to call him Barnaby Beveridge now, I think, but the sort of Beveridge kind of scale of ambition to really kind of remodel what floods mean to this country and the benefits that can flow from preventing those. It requires an intervention at scale, and I think finance has to be a critical part of that.
So we're being yanked off the stage. I'm being told, please wrap up, and we have lunch to eat as well. So we're going to end, and I'm going to end with saying, if we close our eyes several years ago and said why we set up the Conduit, it is for conversations like this, because we don't have a dog in this fight other than wanting there to be a solution. And what we're trying to do is find all the innovative ways that everybody can collaborate with each other and solve this together, because this is a problem that we cannot do in isolation. It will require a community of people, Ubuntu group of people. I am because we are, and that is going to become necessary. So we want to enlist you into this. I've been told I may not take any questions, and we will discuss all of this during lunch and in subsequent events. But please go up to lunch, and we will follow up after lunch. But thank you so much.
Welcome back, everybody. Hope you all enjoyed your lunch. We will start in about 60 seconds, if everybody would like to grab a seat and make themselves comfortable. Great. So, welcome back, everybody. We are going to spend our next session looking at something that really is the core of the whole industry, the question of risk, risk modeling, risk management, how we understand risk, and with particular reference to climate-related risk. So now everyone's settled, I would love to introduce our panel. I'll sit down while I do that. So risk is core to the industry, but as weather patterns become more unpredictable and extreme events become more common, risk is a harder job to predict than ever. So we have a very well-qualified panel with us to explain how risk modelling and management works, where it doesn't, and where it might be going. So Henning Gloystein is Eurasia Group's practice head for energy, climate, and natural resources. He covers geopolitical risk in energy and raw material supplies, the green transition, and advises on industrial resilience and decarbonisation. Henning, welcome. Caitlin Healy is a senior policy advisor in the Resilience Directorate of the Cabinet Office, which is responsible for the UK government's preparedness and risk reduction, and also leads the National Security Risk Assessment, the government's tool for assessing the most serious risks to the UK, and its public version, the National Risk Register. And Robert Muir-Wood is Chief Research Officer for Risk Management Solutions, now part of Moody's, a visiting professor at UCL's Institute for Risk and Disaster Reduction, and the author of 8 books, the most recent of which, This Volcanic Isle, was listed by the Daily Telegraph as one of the 6 best science books of 2024. So, welcome, all of you. Thank you very much for joining us. I thought I'd begin with a little bit of a sort of risk 101 question. It's something that we reference and we speak about quite a lot over the course of the day. But I wonder, Robert, perhaps we could start with a brief overview from you of how traditional risk modelling works, particularly in relation to climate.
Okay, thank you very much. Thank you, everybody, for coming to this session. So just to explain who I work for, what I do. I work for a risk modeling company, so they're not very well known, I think. If you're in the insurance industry, you'll know all about them. If you're outside, you may not, but a risk modeling company, all we do is model mostly catastrophic risk all around the globe. We are a privately held company. There were 1,400 people in the risk management solutions when we got acquired by Moody's 3 or 4 years ago. So among those 1,400 people, there are more than 100 PhDs. So we specialize in everything you need to know in order to model risk. So what is risk modeling? Well, I mean, basically, history is not long enough to tell us every bad thing that can happen. So we create a synthetic history. We create a synthetic history of maybe 50,000 or 500,000 versions of next year in which we simulate a wide variety of potential events. I mean, we want to explore and we are looking at events of all kinds of climate types, or the whole variety or the whole gamut of climate types, earthquakes, terrorism is another area we look at, and so on. We respond to what the insurance industry needs. So our clients are almost all insurers, reinsurers, reinsurance brokers. They need to be able to quantify risk, to measure risk, to price risk, to diversify risk, to reinsure risk. On the models we build, tell them the answers to all those questions. And that may be enough of an intro.
The crucial element within all those models is the data that's used and the build of the models themselves. Now, obviously, within the industry, lots of different insurers have models of their own, and they have data of their own. I was speaking just before this with Jonathan Clark of the National Emergencies Trust. I don't know if he's around, and he compared that model to what we see from airlines. So after a crash, airlines share information about what happened, what went wrong on the plane. But the insurance industry doesn't tend to do that quite as much after a climate event. And Caitlin, I wonder what your thoughts are on how there could be or should be better collaboration between insurers, but also with government.
Thank you, and good afternoon, everyone. Very happy to be here. So I work in the Resilience Directorate in the Cabinet Office. We run sort of central risk assessment processes all across government. So we work with every other big sort of government department. So kind of, for example, DEFRA would own the kind of climate type risks, and then that's Department for Food, Environment and Agriculture. In terms of the sort of importance of understanding risk, collaboration sits at the heart of it. And particularly at the moment, we're very much looking to move more towards like a whole society approach to both preparedness and risk. In order to do this, we need to collaborate with everyone. So it's not just government sharing data with it, like with each other. We need to be working with the local tier, the insurance sector, and also for other sectors as well. And I think really as we try and build that bigger risk picture, would really try and encourage that kind of collaboration. You know, obviously not only just between government and the insurance industry, but also are there ways that, you know, you could learn from each other within, you know, putting in sensible things so you can keep all the kind of commercial elements that obviously are there as well. But obviously a lot of the times when we're speaking about these things, there are really big, significant impacts to the UK and have massive impacts to people's daily lives. So if there is anything that we can do and things we can share and findings that we can share, would really encourage that. I think obviously the UK has gone through lots of kind of big crises. We had COVID, it's probably the biggest, one of the biggest we'll ever face in any of our lifetimes. Huge amounts of learnings have come out of that one. But there are like so many other risks out there that we also need to try and understand as well. So I think just that collaboration, sharing data, finding those lessons when things do happen, learning from them so that the next time something happens we can be that bit more prepared is really, really important.
And we were speaking just before about this idea of sharing data, competitors sharing data effectively. And it's a slightly controversial idea within the industry, but is something that could potentially benefit the whole industry and the rest of us. Is that a fair comment, do you think, Henning?
Yeah, it is controversial in the sense that there are some insurance companies and reinsurance companies that have very sophisticated models. They've spent a lot of money on this, and they're a little bit reluctant to share it with potential competitors who might be seen as hoping to freeload on this a little bit. But it would help. I mean, I'm glad we've got a responding company represented on this panel, because I come from this a little bit through a backdoor in the energy sector, and we became aware a few years ago that most energy companies, when they do their weather and climate forecasting, they base most of these models on past weather and climate events. So if you forecast, put your models on the heating degree days, for instance, for the UK or West Europe in general, and they're all starting to be a bit off because there's not that many heating days anymore. Also, it's become apparent that March has much more frequent cold spats than it did in the past. It's not fully understood. But anyway, so a lot of the energy sector had misguided data, and then we started to talk to insurance companies and ask, well, when you do your risk models on weather and climate, what sort of models do you use? And a lot of them were saying, well, so we're using past data and we're just projecting it. And I say, okay, that's a bit risky. So there's clearly a data lack here. And then the agricultural industry uses those, obviously insures itself, makes investment decisions on land use, whether they can have a profitable agricultural industry on certain lands based on these models. And if those models aren't accurate, then you have a cascading impact, and basically the reality looks a bit different to what was modeled. So I think we are in big need to improve our data in this area.
And so where do the biggest challenges for those models lie in relation to climate? Are there certain geographic areas or types of extreme climate that are harder to model?
I mean, the first thing to say is that we actually make future versions of our models. So we make versions all the way through to 2100 of all our principal climate risk models. I mean, the most difficult models to build are simply the ones which you have the least data for, the ones which are where the events are least frequent. So we know a lot about UK flood because it happens rather often. We may know much less about earthquake in Istanbul or somewhere because we haven't seen that event for a very long time. So I think we attempt to model a very wide range of climate hazards, and some are easier than others simply but through the availability of data.
And how is technology, I'm thinking particularly of AI, helping us to get a little bit better at modelling that data? I'm thinking in particular of Google's Gencast, which can now predict hurricanes a couple of weeks in advance, when previously we had sort of 2 or 3 days understanding. What are the big shifts that are happening there?
Well, you've mentioned one. I mean, this ability to instead of actually running the whole climate for the next 2 weeks in order to simulate what's going to happen, we can actually look at the past relationship between the weather today and the weather in the future, and actually use AI to estimate an alternative to a conventional weather forecast, and that has proved higher skill than a conventional weather forecasting approach. So that's just one example of the application of AI. I mean, we can assume that through loss data, claims data in insurance companies, there's going to be so much learning to be developed from the analysis of that loss data, which will be employed back in the model.
And so then what does that mean for this big question that we've touched on a number of times across the course of the day today of uninsurability? As these models get better, get more precise, and are looking forward, starts to improve in its accuracy, how much of an impact is that likely to have on those areas and properties that we've been talking about that are becoming uninsurable?
Well, I mean, we have effectively what we call Pandora's box, and we opened this box about 20 years ago for the first time. Before that, they simply flat-rated insurance. They assumed there was no better way of doing it than making everybody pay the same. Once you start modeling the risk, once you start showing that the risk can be differentiated right down to a street, right down to a house, then that's no longer the case, and you have the ability to discern the fact that the people who may be living next door to each other have very, very divergent levels of risk, one of which is insurable, the other may not. And in the UK now, this is a policy question I'm wandering into, and actually maybe I'll hand that on to talk about flood re, because that's an innovation of risk sharing based on the fact that we can actually quantify risk right down to an individual property level.
So I think with this one, transparency of data is really important here. And I think in terms of the government, we share lots of things that we can. There is obviously some things that we can't share, but generally the UK government, we are a transparent by default approach. So there is huge amounts of data that can be sort of looked at and can help kind of fuel all of this. I think also as well, there's something that we need to switch a bit more to about maybe looking a bit more about sort of mitigating risks and a bit more about prevention rather than just responding. So is it, actually to use this information and try and build that into the models, build that into kind of the strategies going forward to try and actually, maybe solve some of these issues before, they're actually going to happen. And maybe back to your sort of previous question that AI is probably there as a helpful tool and a huge potential to help maybe send like a few more kind of recommendations of things that we should be looking at, because it could obviously analyse the data and spot trends that would take sort of a human a much longer. So that might be another option as well.
I think there's a problem in the insurability and the relation to climate change here at play as well. Is like, yes, you have these problems already occurring in, West Australia, in California, in Spain, so in the UK, in wealthy countries. But if you look at the regions of the world, and we were talking about this the other week, that are most exposed to the most dramatic effects of climate change, they are also the regions with the biggest demographies in the world, and they're poor. And so that's basically it's South Asia and parts of North Africa. And so if, first of all, in many of those areas, there is no insurance available, and and there's not enough data. If there was enough data, would the insurance be so expensive that nobody would be able to insure it in those regions? And then what does the entire exercise do to you? So basically, is it insurable, yes or no, and is it affordable? And I think, unfortunately, the answer to that is quite often it is either unavailable or because the data is not there, or it's unaffordable because the economic circumstances. And a very good example is India, which over the last 3 years had in March and April more than 50% of its land had average temperatures of above 50 degrees centigrade. That totally changes their outlook for agricultural production, for health and safety. And I don't think any of that is insurable. But I also don't think we've got the adequate data to do that. And that's a bit of a headache because we're talking about sort of people, South Asia and Africa, where probably 3 to 4 billion people are affected by this.
I mean, that is potentially quite a bleak outlook, isn't it? That we're actually saying the risk is too great, and there doesn't seem to be an immediate solution there, is slightly what I'm hearing.
Yeah, I mean, so I've heard some, but I'm no expert in this field, but I've heard some approaches that go towards trying to find sort of a global climate insurance model that's based on the vaccine policies of the last couple of decades, that you make sort of make pharmaceutical goods cheaply available for poor regions in the world. These approaches do exist, but of course in the current geopolitical environment, they look a little bit more difficult to implement. With especially in the United States, you probably need US aid for this. Yes, and which we don't have.
Yes. Ken, you spoke earlier about the idea of whole of society resilience around the idea of mitigation. So how do we bring business, government and communities together, and what's the role of insurance in that to help build that whole of society resilience?
So first of all, what a question that is. I think, so I've said this already, but I think it's really just about collaboration is the heart of it. I think for the insurance industry, I would really say, come and approach government if you've got different ideas on what you don't know. We are there, we don't know what we need to help and what we need to do with, so think about how you can approach us in different ways. Sometimes if it's climate focused, the Met Office can be quite helpful as well, and we're actually doing a project with them at the moment to try and look at how we're going to sort of run a sort of insurance stress test for flooding that we've actually given some specific data for. So I think that's something that we wouldn't have done if that request hadn't come in. So I think really as well, just trying to be part of the whole process. So don't necessarily wait to be asked or wait to be consulted. If you have met someone, try and get it in that way and share your ideas. Whole of society resilience is also more than just like the risk. We also need to look at what the capabilities are that we need to be able to respond to risk. And that's something that we're, like personally in my team at the moment, we're looking a lot into. So it's actually really working out, okay, this is going to happen, but actually how are we going to respond to it? Do we actually have the resource to do that? So that would be something that I would really look at as well within that wider piece. I think, the insurance industry has a massive, massive role to play in whole society resilience. So yeah, very happy to work with you and please let us know what we can do better.
We've spoken a little bit about technology and the impact that technology can have on our modelling. We have a tiny bit of technology here today, which I think is about to flash up, which is the chance to ask your questions via something called Mentimeter. So if you can see the QR code there, and if you had a question to ask and wanted to scan it, you can pop that down and send those in to us there so that we can stack those up. It's also on the screens on the side, which might be a little bit easier to point to than the one that's behind us. I want to come back to this question that we had around government and the industry sharing information. The flip side is that the industry has lots of information, and these models can better help businesses and policymakers to make better informed decisions. But policymakers don't always necessarily listen to them. So I'm thinking about land use, for example. We've made reference to house building in the UK. We know that there is a housing shortage. We know that there's pressure on politicians to build more homes, but we also know that there were more than 100,000 new homes built on high-risk flood zones planned for the next 5 years. So what can be done to improve that conversation so that policymakers and our elected officials pay a bit more attention to those risk models, do you think?
Well, the first thing to say is that floodplains have a very bad rap. It seems to me at this meeting they have a bad rap. You can build on floodplains fine as long as you recognize that the plain is going to be flooded from time to time and you build up. All you have to do is go along the Thames and you can look out of the train window going into Paddington and you'll see houses which are raised off the ground because they've got the amenity value of the river right next to them, and they've chosen to live there, and I imagine they're buying insurance, but they're 1 or 2 meters off the ground level. You can do that in many floodplains, and then you don't need to talk about the fact that you're building in floodplains as being a bad thing. It could be an informed thing. The problem is building without proper information about what is the probability and the height of flooding. I mean, I think that's an example where you're quite right. There needs to be a better sharing of data to make sure if you're taking decisions about risk, about adaptation against risk, against accumulating climate risk, that you're taking it in a really informed way, and therefore the industry, insurers, risk modelers are all potentially able to offer you information which is important to make sure you're making a society which has significantly reduced its risk.
So when we spoke previously, you also talked about what we could do if we come back to that question of the risk impacts in the global south and some of the poorest countries having some of the worst effects of climate change. We talked a little bit about that on our previous call, Robert, and your solution there was much more around the regulation of how people rebuild to minimize that risk. This is an extension of that point I think you were just making.
Sure. No, I mean, once you start getting into the developing countries, into poorer countries, and the challenges that people may well be living in places which are very, very risky, and where you need to help people. They may not realize they are living at such risk. I mean, and there are many things which we can do. And the most important is to try and enforce building codes, in particular building codes against wind, against flood, against earthquake. And if you can achieve that, you'll bring the level of risk down to a point where insurance is much more viable option. So the starting point, I mean, we live in a sophisticated society which has lived with flood risk for hundreds of years. So a lot of decisions have been taken effectively not to live in certain places, not to build very low-lying properties. You may go to a country in the Caribbean and they haven't absorbed that information in quite the same way, and they need help in actually creating a building stock which is low risk and therefore insurable.
So we are about 5 minutes from the end. We have 4 questions that have come in. So we'll have a quick look at those. Before we move to those, I wonder if each of you could give me a quick take on what you think the future of climate-related risk management looks like.
So, when before I sounded a little bit like a doom-monger because I'm a political risk analyst, there's opportunity and solutions already. So, yes, the past data might not be ideally suited to project or forecast the future, but the data is getting better all the time. I mentioned the risks around India, but India is a data superpower in the making. There are a lot of fintech solutions and data solutions that, from the private sector that can be where you can approach governments. There's also at the United Nations level, the Loss and Damage Fund. Part of that could be used to help in the insurability of land in emerging markets. I mean, Indonesia is a very good example. I used to monitor Jakarta quite closely. In Jakarta, there's like one street per year basically gets swallowed by the ocean. And to the point of should you be building there is one question. And if you can just find areas of Jakarta where you can actually build more safely and then provide some form of basic insurance and provide data, I think would be well advanced. And I think we're going to get there. So I'm cautiously optimistic.
So mine would be not assessing risks in silos, really looking about the interdependencies between risks and really trying to take that sort of big whole picture point of view. You know, so obviously there are different types of climate risks, but there's also climate risks sort of as an overall thing. And I think really just understanding how different risks interact, and then also data collaboration and really focusing on that capability building as well.
Yes, I mean, I've said at a meeting here before, I mean, my number one priority would be to educate people about risk, to start teaching risk to 6-year-olds through playing snakes and ladders, whatever it takes. But getting people to comprehend risk then is the start of a conversation you can have about identifying what risks they currently face, which in developing countries, a lot of people who are marginalized end up in high-risk locations, living on the beach, living in flood zones, and so on. But actually taking action, informing people, taking action to understand their level of risk, and then you can start reducing it. You can't start reducing it until you understand actually what it is.
We've had a number of questions come in. We are running quite tight on time, but I just want to see if we can squeeze a couple of those in. There was one that just came up on the emerging secondary risk of freezing and subsidence in the UK and whether that's being built into risk models. Would any of you have an input on that?
Well, the answer is yes.
Great. So yes, it is. And whether, what else have we got coming up here? Maybe we can squeeze one more. How are tipping point data sets being incorporated into risk models?
Well, I mean, with a sort of a watchful interest, because a lot of tipping points are there. I mean, there's obviously a question about when they're going to occur, and there's a lot of uncertainty around that. And you know, we're looking out into the future. I mean, you know, we see tipping points as being very significant over a sort of 30 to 50 year time frame, probably less significant over a 10 to 20 year time frame.
There are lots more questions coming in. There's lots more that we could discuss about this, but unfortunately we've run up against the clock. Before I introduce my next session, it would be great if you could say a wonderful thank you to our panel on risk management. Thank you. I think we're going to move straight on to the next panel. Thank you very much for your contribution there. So we talked about it a little bit in that session, but we're now going to go on to discuss the power of collaboration. If I could welcome to the stage our panel, moderated by Very Sharp. Are we all here?
Thank you very much.
Thanks.
I've got a little fan club in the front. Hi everyone. Good afternoon, everyone. I'm Very Sharp. I'm the Chief Executive at the National Emergencies Trust. For those of you who haven't heard of the National Emergencies Trust, we were set up in 2019 as a directive from the Charities Commission of England and Wales following the series of incidents in 2017, Grenfell, Manchester Arena, and the 4 terror attacks in London. And our role at the National Emergencies Trust is twofold. In the response phase, we're there to support survivors. We're there to support the bereaved, but also to support communities. We work mainly in the preparedness phase because thankfully there aren't national emergencies on a daily basis. And the preparedness phase is so important. During this phase, we're working with survivors, corporate groups, and the government to ensure that future survivors are better served and that the impact of emergencies is lessened. So today you're going to hear from a fantastic panel. They're going to talk to you about collaboration across sectors, multi-agency collaboration, but ultimately collaboration to ensure that resilience plans are people-centred. So I'm going to hand over in this direction. Catherine can go first just to do a quick introduction.
Hi, good afternoon, everybody. I'm slightly blinded here, which is probably a good thing because I can't see how many of you are out there. My name's Catherine Thomas, so I'm Chief Corporate Affairs Officer for Clarion Housing Group. Clarion is the largest housing association in the UK. We are completely not-for-profit. We own and provide and maintain homes for 125,000 households in the UK, over 370,000 residents. And as we are not-for-profit, collaboration is absolutely critical. We don't have the technology or the resources to be able to do the things that we have to do or that are expected of us to ensure that we meet some of those net zero and regulatory commitments that we've signed up to. So we are working in collaboration with government and with technology providers and with construction teams and looking at innovative finance all across the UK. The Housing Association business model is such that we collect rent from social housing tenants. That rent gives us the income to maintain all of our homes. We provide 1,500 repairs and maintenance jobs a day. That's over £1 million a day we're spending on maintaining existing homes. And then all new homes, so we have built over 10,000 homes in the last 5 years. We'll do more than that in the next 5 years, hopefully, to meet the government's 1.5 million house building target. And all of that money comes from debt finance. So we've got about £4.5 billion of finance that we use to build new homes. So as you can imagine, collaboration is everything to us. So I'll perhaps hand over to someone else now to introduce themselves.
Okay, thank you for that. Hello everybody, good to see you all, and again, like you, glad that the lights are blaring and can't see how many of you are there. My name is Heather Shepherd and I'm from Flooded People UK. It's actually a new initiative that literally has only been going for a month or so, but actually what we're trying to do is fill a gap of support for people who have flooded through experiences that flooded people already have or those at risk that can be discussed on a platform with other people affected to give mutual support, but also as a kind of discussion point to find out exactly, you know, what really is a commonality between all of flooded people and what could we do with policy change and where we need to see more help and support for people. But also there's another side to this as well, where we hope to kind of collect the data and the things that are important to flooded people so that we can campaign and see that flooded people are, some of their issues are addressed and change for the better, really, I suppose. So my experience has been 27 years working at the grassroots with flooded communities across the whole of England and Wales. And in that time I have spoken to hundreds of people, worked with hundreds of groups in the recovery of flood, so immediately after a flood, but also helping them through to gain more resilience themselves by leading that and working alongside people that can make a difference to them. And I hope that that will come across a bit in this discussion today.
Hello, I'm Sharon Pickford. I'm the Director for Experience and Revenue at the National Trust. You've met my better half already this morning, Harry, so he's the fun one. So brace yourselves. I haven't got any slides, no fun pictures. I didn't even bring any scones, so I'm sorry. So I've been with the National Trust for 10 years. My job's to develop the business models that the National Trust uses. We've got a brilliant model that's worked for us for about 130 years, where it's a fabulous social enterprise model where we look after some incredible assets on behalf of the nation. We open them to the public. We do brilliant conservation work. The public come, they pay for their membership, they pay for scones and teas and coffees in their millions, and that money goes back into conservation and restoration of the places. We just launched our new strategy back in our 130th birthday in January, and that new strategy is about really doing much more to make a societal impact. Nature's in crisis. We're in a climate crisis at the moment. We've got an opportunity to create a movement of millions and millions of people in the UK to care for nature and to do something supportive of it. And so that means we need a slightly different, more adaptive model for that. So looking at how we are working in a bigger, more collaborative space, being very generous partners, and thinking about the roles that we can play in delivery, but also in convening great partners together, which is a brilliant opportunity to be here today, because you guys have got a lot of opportunity. These ecosystems, these nature-rich ecosystems that we're looking for recovering, you've got as much opportunity and benefit and kind of great will to get this right as we have. So excited to be here today, but I'll hand over to you, David.
Thank you. Good afternoon, everyone. My name is David Mazuka, and it's a pleasure to be here. I'm lead instructor at the National Center for Disaster Preparedness, which is at Columbia University's Climate School in New York. Much of my experience has been both in the academic and government spaces. In addition to teaching, I have also served as a research fellow at Kyoto University at the Disaster Prevention Research Institute, going on 3 years ago now. And prior to that, my government experience, I was with the state of New Jersey following Superstorm Sandy, in which we received federal funds that allowed us to rebuild infrastructure and homes that were damaged and destroyed during that disaster. My role there in government was as assistant director for housing recovery with the state's Sandy Recovery Division. It's, again, a pleasure to be here today and look forward to everyone's questions.
Thank you all. An incredibly varied panel and hopefully a different flavour to what we've had this morning as well, very community focused. So at the National Emergencies Trust, we receive incredible, overwhelming support from corporate groups in the response phase. However, during the preparedness phase, it's not sexy. It's very sensible. It's not glamorous. And very few people can get excited about supporting it. The question to the panel here is, because if we get this right, if we get preparedness right, we will save lives, but we will also save money. And that's a great thing too. So how can insurers and how can the finance industry come together, work alongside grassroots organizations to bridge that gap in preparedness? It all comes back to collaboration again. I'm going to go for Sharon first, but do put your hands up.
I caught your eye there. That was a mistake. I mean, it is literally all about collaboration. I can't express it enough. You've heard it all morning, actually. I've been watching upstairs on the live stream, and you've heard it again and again. This isn't a single unity or a single entity that's going to address a climate crisis or a nature crisis on its own. We own just shy of 2% of the total UK landmass at the National Trust. We're one of the biggest landowners in the UK. And we can't do it on our own. We won't be able to do it on our own. Nature doesn't stop at boundaries, unfortunately. It doesn't have its own little cluster in which it works. It relies heavily on movement and transferal into different spaces. So, something like 43% of the UK rivers flow or touch or run through National Trust land. That's nearly half of all the rivers in the UK. So we've got an opportunity to work at a catchment level, unlike many others. But that catchment level will touch many different landowners. It will involve many different villages and communities. It will involve government bodies. It will involve local authorities. It will involve insurance companies, banks. It's such an enormous collaboration of a scale that we haven't seen. And I think the urgency that we need to act is quite an interesting topic for this particular panel at the moment from a collaboration point of view that says, we've been involved in lots of conversations. One of the great things about the National Trust is we are a brand that's well recognised, well trusted. You know, I think NHS is the only thing that the brand that's recognised or trusted more than the National Trust. We're second in the UK. So we've got an ability to open doors, which is a fabulous privilege. But there's a lot of conversations and very little kind of action that we need, that we're getting to at the end. And that sort of sense of urgency that we're feeling at the Trust is one that I kind of would urge you all to think about, that says, how do we move this from a conversation where we know we need to collaborate, we know we need to bring people together, we know the power in our systems will come from an adding of our collaborative efforts together. How do we do that in a way that is faster than having lots of individual conversations? Today's brilliant. Does that alarm mean I've finished? But also the opportunity to think about how we do it gracefully, generously, without ego, in a non-hierarchical way, and not reliant on the usual people, the usual suspects to bring us together. I think that's a big challenge for us, but collaboration is absolutely key. We've found from the Trust that we're talking, we've just set up a new, sorry, I'm banging on now, but we've just set up a partnership called Nature North. It involves 50 partners that have come together across the powerhouse of the North region to say, how can we be a power for nature, coming together and uniting all of these things together? Funding it's one thing, but actually delivering it is just as difficult. So yeah, collaboration's key in all of this.
Couldn't agree more. 42% as well. That's a great statistic that will stick with the room, I'm sure. I mean, you talk about collaboration. During the COVID-19 response, the country came together in a fantastic way. It was a catalyst, and it was a great proof of concept that we can actually do it, and we can break through red tape, and we can break down barriers and just work together, and we can get it done quite quickly. But there's a question around how we harness that and how we take it forward. I mean, at the National Emergencies Trust, we can't exist without collaboration. And just to give you a quick example of that, in our COVID-19 response, we raised £100 million and distributed it to support 20% of the UK's population. But we didn't do it on our own, and we couldn't have done it without the voluntary community sector. 15,000 charities transferred that fund and that support across all 4 nations. The government provided funding, but they also provided policy insights, data insights, intelligence. Frontline services were giving you an analysis into what's the need on the ground. The public were coming forward. Yeah, they're often forgotten, the public. They're so valuable. They're an incredible asset. You know, almost 70 million people, and if you communicate with them properly, they will be in your hand and they will do whatever you might need them to do for the country. But corporates came together as well. Corporates were one of our major donors, 40% of income for us. But they didn't just give us money. They gave us expertise. They gave us data scientists. They gave us chief risk officers and incredible brand awareness campaigns. And it just proves that if everyone comes together, puts ego aside, and collaborates rapidly, 13 million people can be supported in their time of greatest need in a matter of 6 weeks. So I'm going to move on quickly, and I'm going to come to David and also to Heather on this one. Each of you have got the privilege of working with communities, supporting communities, learning from communities. But many communities are now trapped in this cycle, this annual cycle of climate risk. You know, Christmas, floods, Easter, wildfire. Look forward to Halloween because the wildfires will go out, the floods will come back, and it's Christmas again. That constant cycle. So what lessons can be learned from communities, and who's been practicing resilience for a long time at a community level, and what's the best practice that we can learn from?
Great, thank you for that question. One thing I think we overemphasize sometimes is hard infrastructure and not discussing soft infrastructure enough. And when I think of soft infrastructure, I think of social capital. Those communities that are able to come together, not because the disaster happened the day before, but because of years of communities building up civic engagement, neighbors talking to one another, and doing a variety of activities that bring neighbors and families together. Now, from my time in Japan, I had the opportunity to travel across the country, learning about how different communities respond to disasters, but as important, reduce future disaster risk. I think of one community in particular in the south of the country, outside the city of Kumamoto, which had an earthquake back in 2016. This community's name was Mashiki. And one of the things done in that community was creating ways to continue engagement to preserve the memory of that disaster and thereby reduce future risk. So some examples. One, this community would host an annual festival celebrating their local sweet potato. That festival predated the earthquake, but now included in that annual festival, they would do a variety of disaster drills. Further, they created a community engagement center sponsored by Kumamoto University, in which community members would not only discuss what future recovery should look like, what infrastructure should be rebuilt, but it also allowed community members to share their experiences. It was lethargic. It allowed the community to heal together. I highlight those two examples, but there are a variety of other examples across Japan, and for that matter across North America, whether it be incorporating in schools, how children learn about risk, or whether you're looking at how communities continue, irrespective of disaster, to just build that level of social engagement. Again, I think this is very important, and this is something that you cannot wait for gray sky days, but you need to begin during blue sky days.
Thank you, David. And I've heard about David's trip to Kyoto. If anyone in the room is interested in best practice in terms of preparedness, he's written a fantastic report. He'll be happy to share it with you. Heather.
Well, we have a country that has got 6.3 million people at risk of flooding, and this is predicted to go up to 8 million. That means that there's 1 in 4 of us that are at risk of flooding. This country really does need to have a seriously big plan to look at the future risk when it comes to flooding. There are actually also 2 million people at very high risk, and to be honest, they are probably flooding at this as we speak, and probably repeatedly so as well. And so when it comes to resilience, there are many communities out there that are already, it's second nature to be resilient. And in actual fact, as I've travelled the country talking to communities, I have met some amazing communities that do some really pretty incredible things regards resilience and put their hands straight to it, no questions asked. So some of these will get together as groups and provide support from non-flooded people to flooded people in just before flooding and immediately after flooding. There are groups that help with EA oversight, Environment Agency oversight, at looking at small brooks and that, where they clean. There are people that get into culverts and clean culverts, check on drains, move trees. There are people that spend thousands on resilience on their own home. I'm talking 40, 70,000. Seriously, that's a lot of money. Resilience is a great thing, but resilience always comes at a cost, and there are many people where this cost is beyond them, and this is a gap that seriously could be very useful to fill. But when it comes to deprived communities, of course, there really is, there's no chance of anyone being able to afford any kind of resilience for themselves, and they are very much reliant on other people. But do you know what? This resilience does not really mean, however resilient we are, I think, in this country, this doesn't mean to say that it's okay to flood. That if we're all resilient and we're all prepared, that's okay. We can flood people because they'll be prepared. They'll be able to endure that risk, and we will have done our job. Because actually, there is more to resilience than that. People suffer trauma. People suffer with nervous breakdowns. There's studies that show that people end up with PTSD after floods. Marriages break up. There's loss. There's bereavement. flooding is a huge life-changing event for people. And actually what we also need to think about is the recovery afterwards, the impacts that flooding has on people's lives, how we can support that better, because at the moment that is not supported well enough at all. And so, yes, we need the country to be, and people personally, to look at resilience, but also we need to provide the support for the impacts that flooding has.
Thank you, Heather. 2 million people currently flooded. I haven't seen it in the news today. You know, it's not a headline. That's 3% of the UK population flooded. 5,000 properties. Thank you.
2 million at high risk.
2 million at high risk, right, okay.
Or 1.9 to be precise.
I was going to say, I can't quite hear. This is interesting.
I will start. I'm Ines Vaden from the Environment Agency. So there are, as you said, the most recent assessment, 6 million properties at risk of flooding in UK. Very important to note, about 4 million is at risk of surface water flooding, which is very new information, and will really need to change the way we address flooding. Of those, there are a number of properties that are of high risk. I think you mentioned 2 million. I think probably not as high as 2 million.
It's 1.9, I think, actually.
1.9. But then you said that of those that were being flooded currently, they're not. So this winter, as someone mentioned earlier, I think it was my colleague Jonathan, about 5,000 properties were flooded. Every single flooded property is a disaster in itself.
It is.
But because of the investment that has been made and the flood defense that has been built in the past 2 decades, about 80 to 100,000 properties were not flooded. We need to do more, but numbers matter.
They really do. They really do. Fantastic figures there. Thank you. Just as Heather was speaking, it reminded me, I met with a lovely couple, Jim and Nora, in Cumbria a few years ago. They'd been flooded for the 8th time. Mm-hmm. They knew they were going to be flooded again. They couldn't sell their house. They couldn't find insurance that fitted them or afford it. But a fantastic local charity, the Cumbria Community Foundation, went in and they turned their house upside down. They put the expensive goods on the top floor, and they were always there for them. But Jim and Nora, they knew that they would be in this house until the day they died or moved to a nursing home. And I think it's just remembering that everything we're talking about today, it's all about the people that we're here to serve. Now, we've got one of our corporate partners sat in the room. Clarion works with us strategically as one of our patrons to support us. And you might want to pick this question first, but I'll let you choose. How can corporate coalitions and insurers and government collaborate more effectively?
Thanks, Vari. And yes, we are very proud corporate partners, and Vari's team have helped me and my teams with some scenario planning work, which is just priceless, absolutely incredible, and 90% of it you didn't know before you started, so it's very well worthwhile. I would say Clarion is 125 years old this year. It's 125 years since a Victorian philanthropist bequeathed his legacy to build homes for the working poor. So thinking about the future is very much the focus of our teams, and we want to be here for another 125 years. So sustainability planning and climate transition planning is absolutely critical at what we're doing at the moment. And as I was saying before, working with partners to develop that and to do trials across the country and to trial dozens of different things with small communities, medium-sized communities, so that we can share those lessons and those learnings across the sector and with government is really critical. And I mean, some of the things that we're doing as well at the moment with private sector, we've got a zero bills trial with Octopus. We are working with Kenza on ground source heat pumps. We've just completely regenerated and refurbished over 100 properties in Chelsea, prime real estate off the King's Road, 100% social housing, and we've put ground source heat pumps in that community, so they no longer have any bills whatsoever. We're also trialling some projects in Tunbridge where we are paying for our residents' bills up to 18 degrees. So we provide them with fuel vouchers as long as they maintain 18 degrees ambient home temperature. The cost of doing that for a year for one resident is about the same cost as 2 nights in A&E. And when you think about the numbers of people who are admitted to A&E because they can't afford to put the heating on, you start to think about how circular this can be if we collaborate and think about this differently. So, but it is very much about the human impact and about it being, as I think somebody said earlier, a just transition. So we need to make sure that although we have to meet those government targets of being net zero by 2050 and no more gas boilers by 2030, we do need to make sure that we do this in a way where it doesn't increase people's bills. So all of those little trials at the moment, you know, we've done some thermal imaging across all of our properties with drones, so we know the energy usage across all our properties across the country. And so sharing that data has become critical. So the more people we can collaborate with, the more little trials we can do, the more learnings we can share. And I have to say, because we are the largest in the UK, we're probably one of the few that has the skills and resources to not just think about these things, but actually start doing them.
Thank you very much. The one statistic that you'll hopefully draw out of this that's really going to stick with me is linking bed nights in hospital to temperature in homes. That's something tangible that anyone can get behind. Now, I'm going to come back to David and Heather. You know, I really want to focus on the planning phase again. What role do local and grassroots organisations play in that resilience and the planning phase? Should we start with Heather?
Okay. So, yes, I mean, I think they play an enormous part, and I think we start again with the community, because often what we do is we plan for communities, making decisions about what we think they need, and rather than working alongside them from right from the start, really. And you know, flood action groups across the country are really great to do this. It's usually about their agenda, set up their time, their place, but bringing together people who manage flood risk and other organisations as well to start planning reducing risk from their area. And what they bring along also is local insight, because actually local people are the local experts of their area, and bring that together with people that manage flood risk, and this can really bring about very innovative solutions that help a community, not only immediately before and after a flood, but also for the future of flood risk as well. It brings about enthusiasm in the community to, you know, regained enthusiasm, I think, actually, because often they, you know, communities have become totally deflated after suffering this kind of trauma, and brings in a new enthusiasm that helps towards a safer and better future. I think the biggest issue that probably is faced is trust. Trust is lost, often before the scepticism, and certainly after it can be very much lost amongst communities, feeling that people don't really care and they're not really bothered and they're not going to speak to them. But actually these flood action groups across the country, they do start to build on that trust. They do start to realise that the people who are managing the flood risk on their behalf are actually human beings themselves and do want to help and do understand. And so usually I come across quite shocked communities afterwards to say, yeah, no, they're really nice people, we can really work along with them. They actually, you know, they did listen. The key is listening and building trust. And if we want to progress, really, people at grassroots are the way forward for resilience. Without them, you know, resilience will be very, very difficult. And we need to build on that, build the trust, build the relationship, and work together, but from the bottom up.
Thank you, Heather. And just a quick one from David.
Sure. I'd like to take the question and turn it a little bit to talk about the role of maybe indigenous knowledge and grassroots organizations. And thinking about an example from North America, specifically wildfires. For hundreds, thousands of years, indigenous communities in North America, both in Canada and the United States, have dealt with wildfires, and in some instances have sought out controlled burns. One example I like to give is in British Columbia, 2021 Mount Law wildfire. Now, 1,000 hectares were burned, but only one structure was destroyed. Why? Because this community, 5-6 years before, went through efforts to reduce ladder fuel and surface fuel. And by doing that, they mitigated the impact of that wildfire. Other communities do similar things, and other communities also do controlled burns. And it's something for us to think about, because too often we look at wildfires as something that cannot be prevented or controlled, and yet there are aspects that we can.
Thank you, David. And thank you for keeping it so swift, because you'll have seen on the screen here I'm being hassled. I'm going to stop asking questions because I'm really interested in some audience participation. So I don't think we have any on the Mentimeter, but please do raise a hand and a microphone will find its way to you. And I can't see anyone, so I have no idea who has a hand up.
Sorry.
Hi. Fantastic panel discussion. Thank you very much. We've talked a lot today about insurance, and I just want to pick up on a point that this panel's highlighted several times. Insurance typically addresses financial loss. It doesn't address emotional harm. It doesn't address those people who sit in their house and watch a river rising and are terrified that their house is going to flood again. And that's why everything we've talked about today, which is about prevention and how we can fund prevention, and actually how we plan for the worst to hopefully avoid it, is so very important. So just a point rather than a question, but thank you. Superb discussion.
Thank you, and such an important point. Thank you very much. And we are all here and we're all open to working with the sector to see how we can work more closely to close the gap in that sense. I can hear shouting from this side, but I can't see you, so I'll let you go.
Okay. Mark Partington from Pinion Risk Consulting. I also spent 12 years living in Japan, and I wanted to ask David whether it's possible for us to engineer the same degree of social cohesion that the Japanese do, because, they start so early in school and it goes right through their lifetime. And I do indeed, I agree with you. I think we've got an awful lot to learn from the way that they approach, their natural disasters, because they are so exposed.
I don't think we can engineer in the same way that the Japanese do, as you said, from youth all the way through elder years. But I do think there are aspects that we can think about, whether it is community events that really try to engage with all members of the community. And whether that's a festival or something else going on, I think more can be done for communities to come together on a regular basis. I think now more than ever. I think, and I'm speaking as an American, there's less interaction with one's neighbor today than there was 20 years ago, 25 years ago. Social studies are showing this. So the more community leaders, whether municipal government leaders or whether it's grassroots organizations, can do more to bring people together, I think that increases social capital, helps with reducing disaster risk, and also just makes a stronger community that people do want to be a part of. But you're exactly right. It's not a one-to-one model by any means. Thank you.
Thank you.
Hi, over here. Hi, my name's Steve. I work on social value quite a lot through procurement, actually. But I'm also a councillor at North Yorkshire as well. And one of the key things we're looking at is how can we bring more social value into financial decision making in particular? Because unless we recognise the economic benefits of it, we're going to still be going down the same route of finance first, cost first, without recognising the true benefits. I just wonder if you've got any thoughts on how can we really tap into the economic value of social value?
So again, I think this comes back to collaboration. We've had so many micro examples from the panel today on do this and it will save money here. But this needs to be done on scale. It needs to be collaboration across sectors to bring that together in one place. And I think there'll be a very, very compelling story. I don't know if any of the panel members wanted to add to that.
Yeah, I think that's a great question, because that's something that we're kind of constantly mulling over as well at the Trust. So, we've got great examples. So Harry, my colleague earlier, showed Godrell Beck, which is, the river that was just during Victorian times, they had a natural flood, a natural weave across. They put it into a particular, almost like a canal channel to make more room for farming, because that was the demand of the times. And then this channel, this beck just got, the faster it got, the deeper, they just kept digging it out, and this channel got deeper and deeper. And actually, we could see what needed to be happen. We could work with the farmer. The farmer was up for making change as well. But it was the local community who were the most demanding of us, and of us to help them in a way that they were happy to fund and support and to help out. And I think that's the bit for me that starts to show. They can see the more you're experiencing. They used to get floods kind of once every decade. It was now twice a year they were getting flooded, and that comes at a huge cost. And it's not just, David's talked about wildfires. We have stately homes in the south where paintings will melt due to the high heat that we've got. These are old, you know, kind of genuine masterpieces that are close to melting point due to the high summer temperatures we're now experiencing that we never used to. And so our volunteers, we have 40,000 volunteers across the trust, they're looking at this going, we want these great artifacts, these great kind of masterpieces to be protected for a next generation. We want our children to benefit from them. So what do we do? How do we do it? So planting trees, creating shade, thinking about the role you play in sustainable kind of lifestyle choices. All of those things start to help. It doesn't answer your question for the economics, because I think that is the multi-million-dollar question that says, you know, we think there's three strands. There's a philanthropic strand. So how do we get the public? How do we get philanthropy, high net worth, grants? How do we get real kind of philanthropic gifts? Trading, payment-free ecosystems is one way of doing it. That won't do it on its own. And then there's a debt lever, a debt management tool, and the financial product behind that. So how do you weave those together in a blended finance that starts to demonstrate you're doing great things for nature and the public are coming with you and supporting you in that? Sorry, longer than you wanted.
But a fantastic answer. I think we have time for one rapid question.
Business model ideas and thoughts, and this is all about the collaboration that was announced earlier that you're part of with the reflood. Now, you're talking about generating revenue streams, but actually it's about creating value and capturing that. The best way you could do that would be for the National Trust, the Crown Estates, and other large landowners of that ilk to buy flood implement the flood measures you want, capture the value by reduced losses, and create huge income for yourselves. Good luck.
Wow. I'll write that down. Thank you.
Hire him. Thank you all. Thank you for your time. Please do come and speak to us. We've got some, come and speak to us about any preparedness or collaboration that you might want to discuss. Thank you all.
Thank you.
$4.20. Hello, everyone. If you'd like to come in and make yourselves comfortable, we'll be starting again in about 2 minutes, if you'd like to come through. Hello, everyone. Welcome back. We're gathering now for our final session, final insights and wrap up. And we are very fortunate to have, for our final keynote in conversation, our co-founder and CEO, Paul van Zyl, in conversation with Dan McGrail, the CEO of Renewable UK. Thank you.
So, for the purpose of this, your remarks are going to be in your capacity as the holder of your current job. Yeah. But I think for full disclosure and for relevance, you should let the audience know what your next job will be starting on Monday.
It sounds like a Tonight Matthew moment of, you know, no, so as of Monday, I'm going to be taking on the job of Chief Executive of GB Energy, or Great British Energy, which is obviously an important part of the government's mission for transforming the UK's energy system into and the so-called clean energy superpower. So I've been selected to do that for at least the next 6 months, and I think for anyone who works in the energy industry or who works in the climate movement, there's been a lot of questions about what GB Energy is, what's its role in the industry, and it's kind of my job to figure out the answer to that. So hopefully, wish me luck.
You should do a little inbox or a message box so this audience can give you some suggestions.
Believe me, my LinkedIn inbound in mails is well, I'm behind on that, shall we say? So.
Okay, so you've played a really important role in stewarding the rollout of renewables in this country, and this country is, in some ways, with all its flaws and warts, a real poster child for how you decarbonize and how you roll out renewables. And so I want to have a conversation with you, both in terms of what you've done, but also obviously what you're going to do, about how insurance has enabled renewables, what insurance might or could do differently or could have done differently. And as we seek to accelerate the rollout of renewables, which is going to be essential in our path to net zero, from your vantage point, what would be the optimal role of the industry? So that's our setting for what we want to talk about. So why don't we start with the beginning? What role has it played in your experience? And just set the scene for the audience.
Okay, so first of all, just a word on Renewable UK and my current role. So Renewable UK is a trade association. We represent about 500 companies who are developers, owners, operators of predominantly wind farms. We work very, very closely with the solar industry as well, but also all of the supply chain and the people who make the technology. You know, that kind of, that's probably where one of the areas where this is really important to talk about. The journey, and you're right in what you say. I mean, our progress as a country, it's not something we're not particularly good at really, as patting ourselves on the back for the things that we have accomplished. But you know, last year renewable energy was about 50%, or just under 50% of our energy, if we could take into account all of the various different sources. And in 2014, you know, about 40% of our energy was coming from coal. And last year, we closed the last coal-fired power station in Britain. And believe me, it's not often that politicians turn up in a high-vis and a hard hat to close something, but they actually did for that. And it is a remarkable milestone. And that has been achieved largely through, on one hand, you know, proving that the technology works. And, you know, ultimately, you know, we're still on a journey in terms of persuading the public of that, but largely in terms of persuading policymakers, you know, that has largely been accomplished, as you can see now from having the clean energy, you know, mission that the government has, but also by sort of a relentless focus on cost reduction. And in particular, my specialism is offshore wind. I was in one of the technology companies, Siemens, in 2010, when we were trying to work out how to get the cost out. And at that point, just to put a number on it, you know, a megawatt hour of electricity from an offshore wind farm was about £150, when the price out of a coal-fired power station was maybe £40. So we had a very clear strategy called Beat Coal, and it was about really micromanaging how we would get down to that £40 a megawatt hour within a decade. And we did it in less than a decade in the end. But a big part of it was technology, unquestionably, and jumping through the various different hoops of scaling up the technology and making turbines bigger, and, you know, reducing the amount of balance of plant and equipment that you needed, but also increasing confidence in the financial institutions that could bring the cost of capital down, but also making the projects more insurable was an absolutely essential part of it. And so, you know, now today, you know, electricity, you know, renewable electricity is the cheapest form of energy, and that simply would not have happened without the sort of convergence of all of those different elements of technology, of cost of capital, and of insurance playing its part as well. Where we are today, and I suppose, you know, to come to what could we have done better, is that I think, you know, we run an insurance event as Renewable UK, and I think, you know, I look at where do we have the biggest insurance claims in our industry, and it's kind of a boring technical point, but fundamentally it's some cables, right? And that's quite a boring thing, but ultimately it's a piece of technology which isn't particularly mature, it isn't particularly new or novel. It's a, you know, it's a cable that sits under the sea. And no one really anticipated the fact that these would be the problems. But of course, the consequence of something as simple as a cable failing is that the wind farm doesn't work. And so, where we can do more is actually how can we target our innovation, how can we target our research and development based around actually where the sort of the pain points are within the insurance sector, and how that can help in future bring costs down even further. So that's one element. And I suppose, do you want me to talk a little about the future, or yeah? So I suppose one of the things and the interesting points is that if you look at where we've got to today, we're about, say 40% of our electricity supply. The bit that I always try to contextualize in all of this is that if you think about energy as opposed to electricity consumption today is about 20% of the energy that we consume as a country, and about the other 40% is currently heat, which is mainly delivered by gas, and then the other 40% is transport, which is mainly delivered by hydrocarbons. So in order to get to net zero, then we need to turn that other 80% into electricity, and that is largely the strategy that we have as a country. So we need to keep building renewables, and we need to keep going well beyond. So the 50% number is a bit of a red herring, really. Actually, we've got to keep growing our electricity system, which means that we're going to put more and more strains on where we can do things and how we do things. So one of the great examples of the challenges that we have in wind at the moment in particular is that we need to work out how to take wind farms further away from the shore. Which means into deeper and deeper water, which means probably in most cases making wind turbines float, right? And that is actually a convergence of fairly mature technologies. A wind turbine is a mature technology, and in the oil and gas industry, we've been making things float for many, many years. So how can we work together to make those types of applications of renewable technology to be as insurable as quickly as possible? How can we work with government policymakers to help bring the insurance industry in that? What do people need to see to be able to increase confidence at a more rapid pace than perhaps we did last time? Because we really don't have time to take a breath and figure all of this stuff out. We've got to work on a continual deployment of renewables, and by the end of this decade, really, we will have more or less run out of spaces where we can build renewables either terrestrially or offshore within easy to engineer places. We need to go into increasingly more complex territories, and that's where we need to intensify our collaboration.
So let's take your case study of floating offshore wind, and let's say that it's a nascent technology or a model that hasn't yet been fully deployed or scaled, and therefore there's higher risk in it than the kinds of either onshore wind or immediate, offshore wind that's not floating. What would insurance companies have to do to de-risk that or enable the rollout of those nascent technologies that they would not be prepared to do now? And put differently, if they sit back and say, well, wonderful, Dan, roll that out for 5 years. Once you've got the models and you've shown it's worked, and then I'll underwrite it. That sounds good because that's what we do. And you're going, we need you to be more adventurous or increase risk or come along with us more. And we've spoken a lot in this conference about taking on more risk because we live in a more risky world, and we also have a clock that's ticking. Yeah. So what would that look like? Because underwriters go, well, either I'm going to have to increase the price or I'm going to lose money. So,
well, I think there is a point about risk and actually the entrepreneurial nature of this. I mean, one of the, and again, we take the floating wind example, which is just because we've started with it. One of the beauties of that technology is it takes what has previously been the domain of nations with shallow seabeds and fairly easy places to engineer, and takes it into a much more global context. So the pipeline for that technology is huge in terms of leased space around the world, but actually the deployment to date isn't very big. So if we can start to engineer our way through this quickly in the UK and become a world leader, and given our prowess in the financial services sector anyway, then the market that we open up internationally is enormous for this particular technology. Offshore wind was basically Northern Europe and and China, frankly, whereas this, if we can successfully deploy it, becomes a global opportunity which we absolutely should, as Britain, grab with both hands. I think really starting to work much more intensively around the innovation that's happening. I almost sort of resist language like nascent technology, because what we're actually talking about is a nascent application of existing technologies. And so really working together to understand exactly what the technical concerns are, or how do we mitigate that as an industry, understanding more about the innovation, sharing data, actually something that we could do better as an industry with the insurance sector and just in general with each other, is how are assets performing, what are the issues that we're encountering, and how can we overcome them technically and commercially is an important part of that roadmap.
Okay, let's pivot a little bit to talk about a topic you and I have discussed, which is onshore wind, solar. When you do major installations and that you're doing it on crowded space, on the ground, in nature, increasingly the renewables industry is also having to think about biodiversity loss and conversely net gain.
Yeah.
And it has to be a buyer of biodiversity credits, or it has to think about this in a more active way, which is sort of paradoxical, because in one way, like, I'm fine if you're going to develop a golf course or a hotel, you should definitely doing, but renewables doing it is sort of, there's a strange sort of question there. And so you've spoken a little bit about, like, there's an insurance play here as well, and tell us a little bit about your thinking about that.
Well, I guess the first thing, and I suppose it's just an observation for me, is on the industry, is that the bar that we are held to, arguably because we are operating in climate change, is incredibly high. So the expectations on renewable energy projects, terrestrially or offshore, is incredibly high in terms of its the expectations for environmental mitigation and compensation, and ultimately the companies that are involved in the industry do genuinely want to demonstrate environmental net gain, biodiversity net gain as part of their projects. So we're doing a huge amount as an industry in areas where you wouldn't necessarily think, but peatland restoration as an example is something that is really a topic we work quite strongly on as an industry, particularly in onshore wind in places like Scotland and Wales, where this is an important topic. And clearly, if and I imagine, and this isn't because we've had a pre-conversation about this, but I imagine that when you look at the risk register of most insurance companies, environmental and climate change is a significant threat. And actually, the work that we're doing in renewables is a huge enabler to solving that problem, or acting as a mitigation to that problem. So for me, essentially, environmental net gain, biodiversity net gain are considered as costs to renewable energy projects today. They are things that we have to do, but ultimately want to do. But at the same time, is there not an opportunity to flip that round and say, instead of it being just a cost for the project, is it not an opportunity for the insurance sector to be able to play a role in mitigating the overall risks to their own businesses? Equally, structurally, as an industry, we've gone past the point of being able to mitigate problems for projects at a project level, and we now need to start to look at it at a national level, and that becomes an interesting question in itself. So, this is most obvious in offshore, where we are, through legislation, setting up something called a marine recovery fund, where developers will invest into that, but that will produce huge. I know you've been talking today about the creation of the 1,000 new wetlands. This is an example where actually, as an industry, we're going to also be underpinning and triggering major sort of biodiversity net gain assets that will be a part of the equation going forward in a way that they haven't been in the past. they've just been project by project. Now we're looking at, regionally, nationally, and potentially even internationally, how do we do environmental net gain and biodiversity net gain in a much more coordinated way.
So let me ask you about, as renewables become increasingly part of the built environment, increasingly part of major infrastructure, they're not sort of small idiosyncratic projects, they're a core part of national infrastructure. They start becoming at risk, particularly of something we've discussed around flooding. They are at risk at the same time, so you could have, the greatest definition of irony would be for renewables to be washed away by floods. And so in some ways, having you part of a project where we think about how to defend renewables and how you then protect them against floods and how you put wetlands above them and how you then sink in revenue streams from wetlands into renewables and create some kind of linkages between them would be an interesting piece of innovation.
Absolutely, and I think there's a huge appetite for that type of innovation, partly because the sector is looking for new ways to work. And also, I think, being frank, renewables is, we like to talk about it being a mature industry, but the reality is it's still only sort of 15, 20 years old as an industry, moving beyond a sort of a set of projects. But we are building projects now which are in the hundreds, millions, billions, major pieces of infrastructure, which do have their own insurance risks, that have their own set of challenges, and clearly anything that we can do to work together with other sectors that opens up opportunities that first of all help reduce costs, but also help mitigate risks for those assets in and of themselves is an area of exploration that we're up for, and we're very much open for, and we have the structures in place to be able to have those dialogues, both with other industries but also with government.
So Peter Maurer spoke earlier, who serves on the board of Zurich and plays an important role in looking at sustainability in Zurich, and was talking about the percentage of assets invested in renewables by insurers on their own, from their own assets and balance sheets, and was saying that Zurich was committed to about 6% of their assets invested in renewables. Have you found that the insurance industry is being a sufficient source of capital for the rollout of renewables? As one thing, it's as an insurer and an underwriter. The other is helping to invest and fuel this as an investor.
There are cases where that is the case, but there are. I would say it's not certainly a major component today in terms of acting as an investor. Majority of investment is coming from the institutional funds that we would normally see active in the space, the major household banks. I'm not saying I don't have a percentage in my head of the overall sort of fleet of assets that we have in Britain, but I certainly think that there is scope to do more. And truthfully, the scale of the build out that we're looking at over the next generation, I mean, the number that's being bandied around is about 40 billion a year in the UK alone in renewable energy assets in terms of capital investment. So for the next 5 years at least, and probably continuing at that kind of run rate going into the future. So sources of capital, the portfolio of assets in terms of like risk categories and classes is broadening. There are more high risk assets which we'll see come forward, like we talked about, like floating offshore wind as an emerging application. But equally, things like fixed bottom offshore wind now are very low risk. The construction risks are very low. People understand them. So ultimately, the opportunity for investment from the insurance sector is significant, but also, the competition for capital is probably reducing somewhat because ultimately you've got such a big cake, or we should have such a big cake for people to go after.
So I'm going to ask you a final question, and this is not asking you to say anything in your capacity as your future job, because you haven't started, and I think you're going to want to be artfully quiet for a while as you try and figure it out and set it all up. But just for this audience, because it's 8.7 billion?
8.3.
8.3. So 8.3 billion, it's it's not a gigantic amount of money in the boards, but it's not a small amount of money. And it's intended to be catalytic and leveraged and to crowd in more capital. And so if you begin to think about all the available sources of capital out there and the ways in which at this really pivotal moment in the UK, you could use this to leverage others, what would be the ideal role that the insurance industry could play as a partner to the government in trying to crowd new capital in?
That's a really good question, and it's probably one I haven't thought about a huge amount. I mean, to be truthful, 8.3 billion in the energy industry is not a huge amount of money. So it has to be leveraged up. It has to be catalytic. And the focus for me of a state-owned energy company has to be to operate in the spaces where private capital, doesn't need that help. So where do I see those spaces today? Well, and speaking here, probably with my Renewable UK hat, just in case there's any journalists in the room, things like long-duration energy storage is a big part of the future mix. Again, we're talking about pretty established technologies being combined into something which is, a new application. Things like floating wind, other areas where ultimately the risks are not as well known as they are for where private capital can operate. So for me to be successful running an organization which is going to operate in spaces which are a little bit more pre-commercial, with the view to scaling up industries and growing industries, working hand in hand with insurance is going to be really important, because and that point about risk and that entrepreneurial opportunity, I would see GB Energy as the purpose of this is something to invest, to enable industries to grow that can ultimately be export champions for the UK, that can make a huge contribution beyond these shores as well as on these shores. So to come together to that opportunity, to understand where the entrepreneurial opportunities are and to take more risk is ultimately something that, I think the government is coming forward and taking a risk. So it'd be great if others did as well.
Well, that's an incredibly good note to end on. I know you have to scuttle off up north, but I do think that that's an open invitation. I think that what we've heard a lot today from within the industry is, I think, an authentic commitment and determination to deploy capital, to think about data and its predictive power to be a tool that can meet this moment, and to think about risk in a more thoughtful and creative way, to adjust the way we think about risk. And that's easier said than done, but I think to have that industry a thought partner to you in your new role would be something that I think would be very welcome and would be awesome for you to take up. So thank you.
Absolutely. And thank you for inviting me. And genuinely, don't be put off by the LinkedIn approaches. I'll be happy to have many conversations once I start next week.
Please contact this man. Thank you very much. So that's it for today, and I'm now standing between you and cocktails and the Ubuntu Lounge. So I'm really going to be quick. I wanted to underscore our thanks to the speakers and to our partners, to Rowan and to Howden in particular, for urging us to play this role. And I just wanted to end with a genuine, heartfelt plea to everybody in the room. The nature of the challenges we have described today are not ones that are capable of being solved in silos. And what has been so interesting about the feedback we've received throughout the day is that there's been a broad and eclectic group of people who've been here with a tremendous array of expertise, and are all coming at this problem from different perspectives. And some people may think of that as a sort of exercise in herding chaotic cats. And I think of that as innovation and fertility that comes in ecosystems. And in fact, the most fertile and innovative things are ecosystems, because they're the places where you can cross-fertilize, where creativity lies. It's in the Venn diagrams of intersections that you often find the most interesting solutions. And if you think for a moment of what we're going to try and do with reflood, you have to start with taking all the data that this country has. And by the way, I've geeked out on how much data this country keeps on flooding and water. I don't know what it is about the UK, but there's like thousands of years, I kid you not, of data around floods and river keepers and a whole world out there. But it has this really rich repository of data from all sorts of different sources. And then the insurance industry has this enormous source of data. And it isn't properly put together and coordinated, for sure. And it also hasn't benefited, and we've had conversations with colleagues in Google and elsewhere, from the kind of advances of what AI can do in taking all that data and then muscling in some kind of predictive powers around that data. So we need data. We need landowners, and we've got some of the most important ones you can imagine as part of this coalition, but they're early days. So Royal Society of the Protection of Birds, you're out there. We know you're out there. Please join. And others. And then what we want to be able to do is to think about where the optimal places to locate these wetlands, how might they be financed. There's an enormous cottage industry of people who are doing incredibly interesting cutting-edge stuff already in this space and are doing it at a scale of 25 or 50 or 100 million pounds that we need to get into hundreds of millions of pounds if we are to try and take this stuff at scale. And then there's measurement, right? So there's really interesting stuff on how we measure carbon with integrity in a non-greenwashy way, how we think about biodiversity net gain and how we monetize it properly, how we do water quality, how we think about the nutrient question in an interesting way. And then there's a whole ecotourism community play around how we go about making sure that these wetlands are sources of economic activity and community ownership. And then before I end, one of the things that I think we do incredibly poorly in our movement is communicate. And we have ceded the communication around the path to net zero to a group of people who are candidly saboteurs. And they're a group of people who spend all the time with a relatively large amount of money, and they don't have the facts, but they can dominate the narrative and dominate the airways, demonizing what we're trying to do, which is really just make this planet habitable for our grandchildren. And it's a scandal that we don't communicate effectively, positively, optimistically, and inclusively around these things. And I think we have to take the communication and the narrative mantle seriously. We can't just be financiers and technocrats. We have to also win the argument. And in order to win the argument, you have to authentically do things that genuinely benefit communities. And you can't treat communities as this post hoc, NIMBY inconvenience that you consult after the fact when you've concocted your plans. I think we have to be more authentic in how we go about engaging with communities and consulting with communities and getting community buy-in and showing communities that these things actually meaningfully benefit them. I'll tell you an anecdote. I went the other day to Norfolk, and there was an incredibly beautiful offshore wind farm off Sheringham that you could look out from the beach in Sheringham onto this wind farm. And they have a little display there which is financed by Equinor and Mubadala. The turbines are done by China something. And then as I went around the corner, carved into the rocks on this beach were the words "vote reform." And they were partly carved into the rocks on that beach, I think, because that community, I am certain, has seen no tangible benefit from those offshore wind farms. In aggregate, They've done an enormous amount for our country, and you've just heard Dan say how important it is. But we haven't yet sort of stitched up the connection between that piece of incredibly important infrastructure with the communities that literally see it from their shores. And so I think joining up that piece of democratic consultation and community engagement with communication and narrative as things that aren't just afterthoughts but are part of the process of doing this is a really important thing. I think not just for our project to try and take wetlands to scale and to show that you can generate this elusive unicorn of an idea of nature of an asset class, and it indeed can be monetized and we can do interesting stuff with it. But it's also part of a kind of practice of what getting to net zero needs to be, which is not pie charts and graphs and abstract ideas that exist in our minds because we geek out and are nerdy about it, as essential as that is. It's part of a way of winning the argument with everybody and bringing them along with us. And so as we do reflood, we're going to try and do that as well. We're not just going to think about the financing and the location and the engineering and all the innovation. We're also going to try and say, can these things be part of owned by communities and benefited by communities and a part of storytelling so that you can go to the both reform but also the climate deniers and say, I reject your premise, you're wrong, you don't have the facts on your side, and what we're doing is something that genuinely benefits people, and people can tell us this because we've engaged with them. They are not consumers, they are our participants and our partners in this endeavor. So we are going to meet as the Insurance Society once a month. It's going to become twice a month because we'll have too much demand. Insurance will never be as sexy, will be sexier all the time. And we really want to enlist all of you to please come and participate and collaborate. Nobody owns this. It's our collective effort. We're just wanting to use the convening power of the Conduit to bring us together and to stimulate innovation and to see all the flowers that can bloom. We will try and create some structure and discipline around the wetlands thing because we think it's a really good idea. But we're trying to create fertility amongst all of us en route. So with that I end. Thank you so much for coming, and let's go and have a drink on the third floor. Thank you.